Okay. Good day, everyone. We are back. We are still on the same question paper, which is November 2022, and we are now doing question 1. We started with question 3, and then question 4, question 2, and we are now on question 9. Our aim was to make sure that we complete the full paper so that you are able to benefit and you know that we have done the whole of paper 1. So we are now proceeding to paper 1, the last question, which we'll be doing in this paper, which is November 2020 paper 1. That is question 1. And question 1 is based on fixed asset and statement of comprehensive income. Fixed assets and statement of comprehensive income. It's just fixed assets and income statement. Statement of comprehensive income is the same as income statement. These are financial statements, and remember, the financial statement are done or they are prepared at the end of the financial year. So it is important to note before we even start doing this activity that the end of the financial statement for this activity is 28 February 2021. So the end is 28 February 21. So if the end is 28 February 21, it then tells us that the beginning is the 1st of March 2020. Because the accounting period is the period of 12 months. So it started on the 1st of March 2020 to 28 February 2021. Very important to note the financial period, the accounting period, the beginning and the end. The beginning is the 1st of March 2020 and the end is the 28th of February 2021. So we are only dealing with the transactions which relates to that period. So we are required, 1.1, you are required to refer to information B for fixed assets. So it will be important that you have this question paper in front of you so that you are able to follow this lesson and you are not left out. So we are now on page 4 and 5 of the November 2022 question paper, accounting paper 1. So if you now go to page 5, there is information B there on page 5, and there is an extract from the fixed asset note. There is an extract there of the fixed asset note, and that is where we have our Roman figure 1, our Roman figure 2, and our Roman figure 3. Our Roman figure 1, we are required to calculate the carrying value. Roman figure 1, the carrying value of vehicles. Carrying value of vehicles on 1 March 2020. If you look at Roman figure 1, there is an extract there of the fixed asset note. And Roman figure 1, in that extract, it says we are required to calculate the carrying value of vehicles on 1 March 2020. So this one is straightforward because the carrying value, the formula of calculating carrying value is cost price minus accumulated depreciation. So it's just cost price minus accumulated depreciation. So we do have the cost price here. The cost price here is 460,000. The cost price is 460,000 for the vehicles minus the accumulated depreciation at the beginning. This is the cost price at the beginning minus accumulated depreciation at the beginning, which is 396,750 equals to 396,750 750. We want to calculate the carrying value at the beginning, and the formula is cost price minus accumulated depreciation. 460,000 minus 39,000, 396,750. 460,000 minus 396,750. The carrying value is 63,250. The carrying value of the vehicles at the beginning of the accounting period. Our vehicles were valued at 63,250 at the beginning of the accounting period. And we are done with Roman figure 1. And then we want to move to Roman figure 2. Roman figure 2, it is where we are required to calculate its depreciation for the year. Its depreciation for the year. And we are still on the vehicles. Depreciation for the year, and we are still on the vehicles. Its depreciation, we are talking about an asset losing its value. Fixed assets losing its value. So depreciation for the year for the vehicles. We must first look at which method are we using. Remember, there are two methods of calculating depreciation. One is the straight line method, which is the cost price method, whereby you just take the cost price, you multiply it by the percentage, and you get the answer. And the second method is the diminishing balance method, whereby you take the cost price, you subtract the accumulated depreciation before you can multiply by the percentage. So it means the diminishing balance method, you are calculating depreciation on the carrying value of an asset. That is why the diminishing balance method is sometimes called the carrying value method. So let us check on the method that you are using for the vehicles. It says here, the business owned two vehicles on 28 February 2021. The second vehicle was purchased on the 1st of November 2020. Vehicles are depreciated at 15% per annum on cost price. Now we have the method of calculating that they are using. It's 15% per annum on cost price. And this business has got two vehicles. Excuse me. There is a new one which was purchased. We are told here the new one was purchased on the 1st of November 2020. So the one that was purchased on the 1st of November 2020, we do have it here. Let's start with that one so that we are able to calculate depreciation. Because if you have got two vehicles and the date of purchase is not the same, you cannot combine them and calculate depreciation at the same time. So we need to separate the two. So we have two vehicles. There's a new one and an old one. Let's start with the new one. Let's start with the new one. The new one, we have the amount for the new one under additions at cost there, where it's written additions at cost in the extract of the fixed asset. The new one, the cost price is 510,000. And the depreciation rate is 15%. So that's 510,000 multiplied by 15%. 510,000 multiplied by 15%. And we also need to calculate the number of months we have used this vehicle in this accounting period. This vehicle was purchased on the 1st of November 2020. So our accounting period ends on 28 February. So it is therefore November, because it's the 1st of November. We are counting November, December, January, February. We have only used this vehicle for 4 months in the current accounting period. So it will be 510,000 multiplied by 15% multiplied by 4/12. Because 15% is per annum. So if we can just say 15%, we will get the annual figure. But because we have only used this vehicle for 4 months, it will be 15% multiplied by 4/12. So we'll get the correct depreciation of this new vehicle. Let's calculate it. 510,000 multiplied by 15% multiplied by 4/12. So the depreciation for this vehicle is 25,500. And now let's go to the old one. The old one, the cost price is 460,000. The old one, the cost price is 460,000 and the depreciation rate is 15%. $460,000 multiplied by 15%. 460,000 multiplied by 15%. 460,000 multiplied by 15%. All right, we are using the diminishing balance method. We are using the diminishing. This is the cost price method. Let's go and verify the method. The business owns 2 vehicles. Vehicles are depreciated at 15% per annum on cost. Yes, we are using the cost price method. So for the old one, it is 460,000 multiplied by 15%, and we are getting 69,000. We are getting 69,000. But remember, the old vehicle, we have already calculated the carrying value of the old vehicle here. That is information 1. The carrying value is 63,250. So you cannot have depreciation for this year, which is 69,000, which is more than the carrying value. So this is then telling us that this asset is now fully depreciated. The value is 63,250, but now the depreciation for the year is supposed to be 69,000. And if we can still depreciate it by 69,000, it will mean that this asset will end up having a negative amount. So what do you do when in this situation? You just ignore the 69,000 we have just calculated, and you come up with a new depreciation. You take the carrying value, which is 63,250. The carrying value, which is 63,250, you minus 1, and that will be equal to 63,249. So the depreciation for this old vehicle will be 63,249. So then the total depreciation will then be a combination of the new vehicle for 25,500 plus the old vehicle, which is 63,249. 63,249 equals to, let's calculate this depreciation. 25,500 plus 63,249. 25,500 plus 63,249 equals to 88,000. 88,749. 88,700. So our depreciation, this is the final answer. Our depreciation for the year for the vehicles is 25,500 for the new vehicle plus depreciation of the old vehicle, which is 63,249, and this gives us the total of 88,749. So we are done with the vehicles. And remember, this depreciation is going to be transferred to the income statement, and we have it in the answer sheet. This is the answer sheet that will be given in the exam, and I've decided to draw it here on the board so that you see what you may expect to get when you are writing it. So the answer sheet is provided with the statement of comprehensive income statement. So that is why it is important that as soon as you have calculated the amount that you will use in the income statement, you need to transfer it. So this depreciation is here. Depreciation, the total is 88,000. 749. And there is also depreciation on equipment, because this business has got two fixed assets here. There is vehicles and equipment, and depreciation for equipment has already been given, which is 31,281 plus 31,281 plus 31,281. So that's 88,749 plus 31,281. All right. Okay, let us continue here. We will come back to the income statement. We are just transferring that this total that we are calculating here will be used in the income statement. So we decided to transfer as soon as possible before we even forget. Now, that is the reason why they provide you with the answer sheet, because they want you to make sure that as soon as you finish doing the calculation for something that is required in the income statement, you then need to transfer. Right. Then let us then continue. Roman figure 3. What is it that is required of us in Roman figure 3? Roman figure 3, we want to calculate disposals at carrying value for equipment. Disposals at carrying value. Disposals at carrying value for equipment. We want to calculate it disposal at carrying value for equipment. There is an asset that was sold. Let us look at the transaction which talks about this. Equipment. Depreciation, that is page 5, where it says equipment. Depreciation is 20% per annum on the diminishing balance method. Unused equipment was sold for 40,000 on 1 October 2020. Accumulated depreciation on the equipment sold was 36,600 on 1 March 2020. So we know that the formula of calculating the carrying value is cost price, the price that we paid when we were buying the asset, minus the accumulated depreciation. As we have been using, the asset is depreciating, then you get the correct value. So let us then check the cost price of the asset that we are selling. The cost price of the asset that we are selling is not given here. And then that then requires us to look deeply into the extract of the fixed asset note. We do have the cost price for equipment at the beginning, which is 360,000. And the cost price for equipment at the end is 285,000. So we need to compare those two cost prices. If the cost price at the beginning was 360,000 and the cost price at the end is 285,000, so it then tells us clearly that the cost price of the asset that was sold is 75,000. The cost price of the asset that was sold is 75,000 minus the accumulated depreciation. But the accumulated depreciation that we are given here is not on the date of sale. The accumulated depreciation of 36,600 given, the accumulated depreciation of 36,600 that is given here is not on the date of sale. It is not on the date of sale. We are told that the accumulated depreciation on the equipment sold was 36,600 on the 1st of March 2020. So we have used, this asset was sold on the 1st of October. So we use the asset from the 1st of March, which is March, April, May, June, July, August, September. We use it for 7 months and we sold it in October. So we need to calculate depreciation for 7 months. So using the diminishing balance method. So if we are using the carrying value method, which is also called the diminishing balance method, at 20% per annum, so it will then be 75,000 minus the accumulated depreciation of 36,600, right? Multiply by 20% equals to multiply by 7. We said it's 7 months, 7 over 12. That is giving us 4,480. That is giving us 4,480. That is giving us 4,480. So the 7 months, the depreciation for the 7 months that we use is 4,480, which then brings the total depreciation up to, this is 75,000 minus 36,600 plus 4,400. This is 4,480 plus 36,600. 36,600 plus 4,480. This is giving us a total of 41,080 equals to, let's get to the answer. So the carrying value for this asset, the updated one, because this depreciation 36,000 was at the beginning of the financial year. We used the vehicle for 7 months, and then the equipment. We used the equipment for 7 months, and then the depreciation increased. It then depreciated by 4,480. So now the accumulated depreciation has increased to 41,080. So we need to calculate the value of this equipment so that we know that it was supposed to be sold by how much. The value of this equipment, the cost price of the equipment is 75,000, and the depreciation, the accumulated depreciation is 41,080. 41,080. Which gives us 33,920. The carrying value of this asset is 33,920. The carrying value of this asset is 30. If this asset can be sold by 33,920, it will mean that the business will neither make profit nor loss, because this is the correct amount for which this asset is supposed to be sold. But if you look at the transaction here, the transaction here tells us that this unused equipment was sold for 40,000. And this now takes us to the question, which is 1.1.2, where we are required to calculate profit or loss on the sale of the equipment on the 1st of October 2020. It takes us to this, where we need to calculate a profit or loss on the sale of equipment, If you look at the price, this equipment was sold for 40,000. It was sold for 40,000. But the carrying value, the value of this equipment, the correct price, the correct amount at which this equipment was supposed to be sold for is 33,920. So the selling price compared to the value, 33,920, is telling us that we have made a profit, so we can confidently strike off this loss. We made profit. There is profit on sale of an asset. This equipment was supposed to be sold for 33,920, but we sold it for 40,000. The carrying value is 33,920. The selling price is 40,000. So 40,000 minus 33,920, we made a profit of 6,080. So the business made a profit of 6,080, which is an income to us. This profit is an income to us. And remember, in the income statement, there is a space for incomes where we need to record the income. So here you have your other income, right? So you have your carrying value here. You have your carrying value of 33,920. The selling price is 40,000 minus 33,920. So this business has made profit of 6,080. So under your other income, you have your profit on sale of an asset. Profit on sale of an asset. And this profit is 6,080. It's an income to the business. The business, your other income, this is an income to us, which is 6,080. Remember, I told you even when we were doing depreciation that it is important when you are doing this calculation, whatever that is going to affect the income statement, it must be transferred immediately before you even forget that there was such an item. Right. Then 1.2. 1.2, refer to information BE for the trading stock. Calculate the trading stock deficit. Calculate the trading stock deficit, 4 marks. So if you look at information BE, it is set there. That is page 5 of your question paper. And information E, you have a table that is provided there for the unit cost, the unit price, and the total. And there is a statement which tells us that trading stock is valued on the weighted average method. The ledger account and records reflects that 280,000 units should be on hand. So we are supposed to be left with 280 units. However, the physical stock count reflects only 262 units. So there are some units which have gone missing here. If you look at the number of units, so the physical, the records are showing that we are supposed to be left with 280 units. But we are only left with 262 units. 262 units, which is telling us 280 minus 260, that is it 262? Yeah, 228 and 262. So this is about 18 units. There is 18 units missing. And we want to calculate the value of the 18 units that are missing. And we are told that this business is using the weighted average method. So it means we need to calculate the weighted average price. The weighted average price, which will be our total cost divided by the number of units. Our total cost is 8,100,000. It is there in information E. Your total cost is 8,100,000. Our total cost is 8,100,000 divided by the total number of units. The total number of units is 2,000. So 8,100,000 divided by 2,000. 8,100,000 divided by 2,000. So we will then get the answer. That is 8,100,000 divided by 2,000. That's 4,050. The weighted average price is 4,050. So weighted average price is 4,050. So 18 units multiplied by 4,050. 18 units multiplied by 4,050, because each unit is valued at 4,050 and there is 18 units missing. So 18 units multiplied by 4,050. 4,050 multiplied by 18 units. That is 72,900. 72,900. So the trading stock deficit is 72,900. Calculate the trading stock deficit. We have 18 units that are missing. If you compare to what we were expecting, 280 units, but the physical count revealed 262, which then tells us that 18 units are missing. And the value of each unit, according to the weighted average price, is 4,050. And 18 multiplied by 4,050 will give you 72,900. And remember, this is an expense which is going to be needed here. So we then transfer it here. Trading stock deficit under operating expenses. Trading stock deficit. We have trading stock deficit, and the amount is 72,900. Our trading stock deficit is 72,900. 18 multiplied by 450. 4,050. Right. Then 1.3. 1.3, prepare the statement of comprehensive income for the financial year ended 28 February 2021 for 43 marks. So we are now focusing strictly on this income statement. But remember, there are some amounts that we have calculated which have already been transferred to the income statement, and there are also other amounts which had already been entered in the income statement in the answer sheet which were provided. So let us then complete this income statement. Let's do it following the order of the transactions here. Right? The business, let's go to transaction because we have dealt with transaction A and transaction A, which deals with the fixed assets. So we are now proceeding to transaction B, which is on page 5. The business maintains a markup of 120% on the cost. Note that trade discount of 648,000 were granted to special customers. That is transaction B. Right? The business maintains a markup of 120%. So this will help us to calculate our sales amount. The cost of sales has already been provided, which is 6,966,000. So we want to calculate the sales amount. So our cost of sales is 6,966,000. 6,966,000 multiplied by 220 over 100. 220 over 100. This should give us, let's do this calculation. If the markup percentage is 120, then because if it was 20%, then it will be 120 over 100. If it was 30%, 130. Now it is 120, so therefore it will be 220 over 100. So 6,966,000. 6,966,000 multiplied by 220 over 100. 6,966,000 multiplied by 220 over 100. That is 15,325,200. 15,325,200 minus, remember the transaction told us that there were some special customers who were given discounts. So minus 648,000 discounts. Minus 648,000. Minus 648,000. 14,677,200. 14,677,200. This is our sales. The markup percentage is 120. So therefore, we take our cost price multiplied by 220. If the markup percentage was 20%, it would have been 120. 60%, it would have been 160. But now it is 120. Therefore, it is going to be 220 over 100. Then minus the discounts that were granted to special customers. And therefore, the total sales will then be 14,677,200. 14,677,200. 14,677,200 minus cost of sales of 6,966,000. Of 6,966,000. 14,677,200 minus cost of sales of 6,966,000. Then the gross profit is 7,711,200. 14,677,200, which is sales, minus cost of sales of 6,966,000 will give you gross profit of 7,711,200. 711,200. Then gross profit. Then we come to gross profit. That's gross profit of 7,711,200. Other income, we are already having the profit on sale of an asset here of 6,080. Let's proceed with the transactions here. We are now proceeding with transaction number C. Transaction number C, it says account of a debtor B Melter 800 must be written off. The account of a debtor must be written off. This will go to bad debts. This will go to bad debts. The bad debts, according to the information A, it is 19,200. Bad debts is 19,200. And we are writing off the account of a debtor. It is 800 rands here. So this is 19,200. Our bad debts are increasing. But remember, as our bad debts are increasing, our debtors control will decrease. This transaction affects two accounts. It is minus debtors control and plus. So we need to note with your lead pencil there, next to debtors control. Next to debtors control, that those debtors control will have to decrease by 800. But here in the income statement, what is affected is bad debts, which will then increase by 800. 19,200 plus 800, that will give us 20,000. That will give us 20,000. Provision for bad debts must be adjusted to 5% of the outstanding debtors. Yeah, I told you that we need to adjust the debtors. The debtors control is 123. The amount given for debtors control is 123,000 minus the ones that we have just written off. Right, so that's 123 minus 123,000 minus 800. Minus 800. That is giving us 122,200. 122,200. Then we want to multiply this. 122,200, we want to multiply this by 5%. By 5%, which is giving us, multiplied by 5%, this is giving us 6,110. So our provision for bad debts is supposed to be 6,110. So let's look at the current provision for bad debts. The provision for bad debts at the beginning. The provision of bad debts at the beginning was 7,030. It was 7,030. So therefore the adjustment, it's clear that the adjustment, if the provision for bad debts at the end is 6,110, provision for bad debts, you can either be decreasing it or increasing it. So if you are increasing provision for bad debts, the adjustment is an expense. But if you are decreasing provision for bad debts, the adjustment then becomes an income. And in this case, we are decreasing provision for bad debts from 7,030 to 6,110. So therefore, provision for bad debts adjustment. Provision for bad debts adjustment. Provision for bad debts adjustment, we are reducing it from 7,030 to 6,110, which becomes an income to us. Decreasing provision for bad debts is an income, the adjustment is an income, but increasing the adjustment is an expense. Minus 6,110. That's 920. The adjustment is 920, which is an income to us. 920. Right. Transaction E. We have already done transaction E, which was based on the trading stock, and that is where we calculated the trading stock deficit. So then we are proceeding to transaction F. Transaction F. It says 30% of the audit fees is still outstanding. 30% of the audit fees is still outstanding, which then tells us that the audit fees that we are given there of 91,000 is 70% if 30% is still outstanding. 30% of the audit fees is still outstanding. So it means the audit fees that were paid, which is 91,000, audit fees, that's an expense. The audit fees that were paid, which is 91,000, is only 70%, because we are told here that 30% is still outstanding. So now we don't want 70%, we want 100%. So it is therefore important that we multiply by the percentage of what we want and divide by the percentage of the amount given. So it will be 91,000 multiplied by, we want 100% of the audit fees, not 70%. So multiplied by the percentage of what we want, which is 100, and divide by the percentage of the amount given. The amount given, which is 91,000, is 70%. So it will be 91,000 multiplied by 100 divided by 70. 91,000 multiplied by 100. 91,000 multiplied by 100 divided by 70. This is 130,000. Let me check. That's 91,000 audit fees. Right. Audit fees is 91,000. And then 30% is still, oh yes, we are correct. 91,000 multiplied by 100 divided by 70. That is given. So it's 130,000. So the correct amount is 130,000. 100% of the audit fees. So the correct amount is 130,000. Because we were told that there is 30% of audit fees that is still outstanding, which then suggests to us that the amount that was paid is only 70%. Right. The monthly rent income, that is transaction G. The monthly rent income did not change during the year. During February 2021, the tenant paid 9,000 for repairs to the premises and deducted this from his rent. Repairs are the responsibility of the company, and this was not recorded. The rent for March 2021 was received in advance. Right. The tenant, so this is rent. Rent income. We want to work with the full amounts. So we are told that rent here, the amount given for rent is 173,000. Amount given for rent is 173,000. 173,000 is given, and we are told that there is 9,000 that was deducted. There is 9,000 that was not paid, because it is said here during February the tenant paid 9,000 for repairs and deducted this from his rent. So this is not the full amount. We need to add this 9,000. And remember, this 9,000 was for repairs, and the repairs are the responsibility of the business. So let's go and check repairs. Repairs. How much is given here for the repairs? The amount given here for repairs is 476,000. So the amount for repairs is 476,000. So it will be 476,000 plus this 9,000. 400, let's check, make sure that we are taking the correct amount. Very important to be accurate in accounting. 476,000 plus 9,000, which will give us 485,000. 485,000. Right here, we have 173,000 plus 9,000. There is another story with regards to rent. There is another story with regards to rent. There is another story. So we have 173,000 plus 9,000. 173,000 plus 9,000. 173,000 plus 9,000, that is 182,000. That's the full amount for rent. But we are told that the rent for March 2021 was received in advance. So it means that this 182,000 now is for 13 months because our accounting period ends on the 28th of February. So we then need to divide this so that we find out how much is the monthly rent. 173,000. Okay, the monthly rent income did not change during year. During February 2021, the tenant paid 9,000 for repairs to the premises and deducted this from his rent for February 2021. Repairs are the responsibility of the company, and this was not recorded. The rent for March 2021 was received in advance. Yes. So you have your 173,000 plus 9,000 equals to 182 divided by 13. So that's 14,000. So we need to subtract 1 month, which is 14,000. How did we get this 14,000? We took 173,000 plus 9,000, which gave us 182,000. That's the total rent for 13 months. And we divided by 13 to get the monthly rent. The monthly rent is 14,000. And we have to take it out, this monthly rent of 14,000, because it's for March. And our accounting period ends on the 28th of February 21. So let's calculate the total, the correct amount for rent now. We have 173,000 plus 9,000 minus 14,000. 173,000 plus 9,000 minus 14,000, which gives us 168,000. 168,000. Right. Adjustment number H. Adjustment number H. The company has 4 directors. The company has 4 directors earning the same fees. One director resigned on the 31st of May 2020. We need to write this information down because this transaction becomes a problem if we are not taking each and every sentence seriously. So the company has 4 directors. This company has got 4 directors, right? One director resigned, so minus this one. So we now have 3. One director resigned on the 31st of May 2020 and received his fees up to this date. He resigned on the 31st of May. 31st of May. So this one who resigned, our accounting period starts in March. It's March, April, May, March, April, May. So this director, there is one director who was only paid for 3 months in the current accounting period because he resigned in May. So that will be March, April, and May. This director who resigned, right? One director resigned on the 31st of May and received his fees up to this date. Another director is still owed fees for January and February. So another director is still owes his fees for January and February. So it means this director has been paid for 10 months. This director has been paid for. The one who resigned was paid for 3 months. The one that we are owing has been paid for 10 months. And it means there is 2 directors who have been paid full amounts. 2 times 12 months. There is 2 times 12 equals to 24 months. There is 2 times 12 equals to 24 months. So let's calculate the number of payments that we have made. That is 10 plus 3 plus 10, 13 plus 24. That's 37. So the director's fees that we are having here, because we want to calculate the number of payments so that we are able to get the actual amount, that how much is each payment to the director, the monthly payment to the director's fees. So let's go to the director's fees. Director's fees Directors' fees is 3,330,000. 3,330,000. Directors' fees is 3,330,000. That is our directors' fees. And this 3,330,000 is equivalent to 37 payments. So if we can divide this by 37 payments, we are getting to know that the director's fee per month is 90,000. We want to calculate the director's fee per month is 90,000. So director's fees we have 3,330,000. 3,330,000 plus we want to calculate the two payments that are owed to the director who is still there, who is owed for January and February. So if each payment is 90,000, so that tells us that two payments will be 180,000. So it will be 3,330,000. 3,330,000 plus 180,000. 3,330,000 plus 180,000, that is 3,510,000. 3,510,000. That's 3,500,000. That is the total director's fees. And then transaction I for advertising. Transaction I for advertising, it says advertising consists of a contract with a newspaper for the entire financial year. Payment are monthly. However, installments were paid for 11 months. Note, the monthly rate decreased by 240 from 1 November. The payments are 11 months, which means these payments ended in January because they are 11 months. So there was also a decrease from 1 November. So that will be November, December, and January. Let's start by addressing this decrease thing. So you have your 240 multiplied by 3. That's November, December, and January. 240 multiplied by 3, 240 multiplied by 3, that's 720. The decrease is 720. The total decrease is 720. We want to add the decrease back so that we are able to divide the amount for advertising. The amount for advertising given is 25,680. 25,680, we cannot divide it by 11. The challenge is that if we want to divide, we can't divide it by 11 because it has not been the same from the beginning until the end. There was this decrease. So for us to be able to divide it by 11, we need to add the decrease back. That's the decrease of 720. It then gives us 26,400. It then gives us 26,400. So we then say 25,680 plus 720, which will give us 26,400. And then this 26,400 we divide it by 11. Divided by 11. Then we are getting 2,400 minus this 240 because it was 2,400 before it decreased. So it is 2,400 minus this 240. So it is now 2,160. This calculation is for advertising. This calculation is for advertising. We started by calculating the total decrease. We had to add the decrease back for us to be able to divide by 11, and we got 2,400 before decrease, and we take out the decrease, and then we have 2,120. We have 2,160. So advertising the amount given is 25,680. 25,680 plus 2,160 for 1 month. 25,680 plus 2,160. That equals to 27,840. 27,840. Right. The last one, the last transaction, it says the net profit after tax was accurately calculated at 1,054,000. This was given, it was given, and the income tax rate is 32%. Income tax rate is 32%. Income tax rate is 32%. Income tax is 32%. So we can just take this, the income tax rate, if it is 32%, this will then tell us that the net profit after tax, if the income tax rate is 32%, then it means the net profit after tax, is 68%. If income tax is 32, because the before tax is 100% minus tax 32, this one is 68. So we have this 1,054,000 multiplied by 32 over 68. You multiply by the percentage of what you want and you divide by the percentage of the amount given. So you have your 1,054,000, 1,054,000 multiplied by 32 over 68. That's 496,000. 496,000. So you have got two options. If you like, you can take the 1,054,000 because we know this is 100%. Let's just use the same method to get the net profit before tax. 1,054,000 multiplied by 1,054,000 multiplied by 100 over 68. But it's not clear now. 100 over 168. So it's 1,054,000 multiplied by 100 over 68. 1,054,000 multiplied by 100 over 68. That's 1,550,000. But another option of getting this 1,550,000 was to just reverse by saying 1,054,000 plus, if you are reversing, this one is a negative amount, so it will be 1,054,000 plus 496,000 to get 1,550,000. The interest expense here, which is interest on loan, has a question mark, which then tells us that the interest expense was going to be a balancing figure. So let us now finalize everything here. We are now closing off the income statement. We are approaching the end of our lesson. We are now closing off this income statement. Let's start with the total for other incomes. Total for other income. We have 6,080 plus 920. 6,080 plus 920 plus 168,000. Plus 168,000. We have 175,000. 175,000. And then we say gross profit plus other income. That 175,000 must be added to a gross profit. That's plus 7,711,200. 7,711,200. That gives us gross profit of 7,886,200. I think this section of now closing it off, most students are familiar with it. Let's give us 7,886,200. And then you have your operating expenses. That's gross operating profit. Gross operating profit. Oh, I had two columns for operating expenses. Let me delete one column. I had 2 columns for operating expenses. Yeah. Let me just delete 1 column. Yeah, because we just have 1 operating expense. We can't have 2. So we have operating expenses. Right. Let's add all our operating expenses up to sundry expenses. These are all our operating expenses. These are all our operating expenses. Let's start by coming up with the total for depreciation there. 88,749 plus 31,281. 281 equals to 120,030. Right. Okay. Right, let's have the total operating expenses. 1,468,000. Salaries and wages, let's verify. 468,120. 1,468,120 plus 120 or 30, 120,030 plus 72,900 plus 20,000 plus 130,000 plus 485,000 plus 3,510,000, 3,510,000 plus 27,840, 27,840. This equals to 5,833,000, 5,833,890. 5,833,800, and this should be in brackets. So it will be now, this will now 7,886,200 minus 5,833,890. 7,886,200. 2,052,310, which is our operating profit. 2,052,310. 7,886,200 minus 5,833,890. This gives us 2,052,310. Right, and then you have our interest income here. We have our interest income. We are now approaching the end of our income statement. We are just closing it off. Our interest income is 25,000. It's given in the question paper, it's 25,000. So 2,052,310 plus 25,000. It's 2,077,310. 2,077,310. And then minus the net profit before tax to get the interest expense, minus 1,550,000. So it's 2,077,310 minus 1,550,000. 527,310, and this is our balancing figure. $527,310. That is our balancing figure, and we want to ensure that we do the right thing. We must make sure that when you are doing the income statement, your calculations must be correct. Your adjustments must be correct, And you must make sure that when you are using the calculator, you punch the correct figures, and even your workings must be shown, because sometimes it may happen that your workings are incorrect, but by following the right method, you are able to get at least a part mark there. But this is what needs to be emphasized here with regards to the income statement. The financial statement is that you need to practice it almost every day so that you are able to do it. And make sure that you do as many activities as possible so that you may pass this accounting. So now that we have completed question 1, so it then tells us that we have finished this paper, which is November 2022. Accounting NSC paper 1, which had 4 questions. So we did question 3, question 4, question 2, and we are now on question 1. Our next lesson will then be based on November 2022, and it will be based in paper 2. We'll be doing paper 2. Thank you very much. All right, welcome back. We are continuing with our paper. We are still doing accounting paper 1. Remember, we have already done question 3 and question 4. So now we are proceeding to question 2. So if we can do question 2, it will then mean that we are only left with question 1 in this paper, which is accounting paper 1, November 2022. Remember, the paper 1 in accounting is based on companies, limited liability companies. And then paper 2 is for those other sections of our syllabus. So this paper is also very important for students to master it. It's also very important for them to do well in this paper, so that when they proceed to paper 2, they know that they have done well and they gain confidence and are able to pass this subject, such a very interesting subject. So we are now in question 2. Question 2 is based on the financial indicators. Question 2 is based on the financial indicators and cash flow statement. Financial indicators and cash flow statement. Question 2, based on the financial indicators and cash flow statement. 2.1, choose the correct words from those given in brackets. Write only the words next to the question number 2.1.1 to 2.1.3 in the answer book. 2.1.1, the director's report or audit report. So those are the options that were given. We need to choose between the director's report and the audit report. Gives an explanation of the operations of the company during a financial year. So is it the director's report or the audit report that gives an explanation of the operations of the company during a financial year? And the correct answer to this one is the director's report. The director's report gives an explanation. The director's report gives an explanation of the operations of the company during a financial year. Remember, the audit report is the report that is issued by the independent auditors after they have audited the financial statement. So the report that gives an explanation on the operations of the company is the director's report. 2.1.2, the independent or the internal auditors are responsible for monitoring the financial control measures of a company on a regular basis. I think the key word to this question is regular basis, because it says the independent or the internal. Remember the difference between the two auditors. The independent auditors are the external auditors who comes only once at the end of the financial statement, at the end of the financial year, and their job is to look at the financial statements, audit the financial statement and write a report. So they are not there in the company on permanent basis. So the internal auditors are the ones who are in the company, they are working for the company on full-time basis. So they are the ones who can be able to monitor the financial controls on a regular basis, which therefore tells us that the correct answer to this 2.1.2 is internal auditors. Internal auditors. As I have already mentioned, that regular basis is the guide. So the independent auditors are responsible for monitoring the financial control measures of a company on a regular basis. No, those are not the independent. It is the internal auditors who monitors the financial control. 2.1.3. In the event of bankruptcy, the shareholders are normally not responsible for the debts of the business. This is because of limited or unlimited liability. If something is limited, remember the liability of the shareholders is only limited to the amount that they invested in the company. Should the company become insolvent, the shareholders can only lose the amount that they have invested. But they will not be liable to pay for the debts of the business. So the correct answer to this one is that limited liability. In the event of bankruptcy, the shareholders are normally not responsible for the debts of the business. This is because of limited liability. Their liability is only limited to the amount invested in the company. There can never be a situation when the company collapses, then the people who are owed by the company will go as far as demanding the shareholders to come and pay this money, and they may be even repossess their personal belongings. No, their liability in the company is limited. They can only lose, when the company becomes insolvent, they can only lose only the amount invested in the company. 2.2, Usanda Limited, the financial year end is 28 February 2021. Year end is 28 February 2021. Remember, the financial year is the period of 12 months. So if the year end is 28 February 2021, it means that the year started on the 1st of March 2020. 1st of March 2020. So the accounting period that we are dealing with in this activity, it starts on the 1st of March 2020 and the end is 28 February 2021. And the name of the business is Usanda Limited. Required 2.2.1. We are now doing the cash flow statement. This is cash flow statement. Calculate the following figures for the 2021 cash flow statement. We want to calculate income tax paid. So this calculation, educators normally use different methods of calculating this, but the most preferred method by myself is the one that we are going to use when we are calculating this. What I normally emphasize to you students is that you should just have one formula in mind. That your SARS income tax at the beginning should be a plus, and your SARS income tax at the end should be a minus. And that if you are asked about the type of an account, what type of an account is SARS income tax? SARS income tax is a liability under normal circumstances, but we do understand that in some instances your SARS will become an asset. So, but we are saying that the beginning should be a plus and the end must be a minus. If everything falls under liability, if the beginning is a liability, it should be a plus. In your question paper, you may see liability, or they may decide not to write it under liability. They may just indicate it as CR, which stands for credit. And if it is a CR, it's still liability. Or your SARS may appear under trade and other payables. If it is payable, it is still indicating that your SARS is what? Is a liability. So therefore, if your beginning is under liability, it will be plus, and if your end is under liability, it will be minus. So should it happen that your SARS is no longer under liability, your beginning is not under liability, it is under assets, or you see a DR sign,
or it is recorded under receivables, then you need to change the sign. If it is a DR, what you need to do, you just need to change the sign. You just change the sign. So the DR may be a DR or written assets, or maybe it may be written receivables. It's just one and the same thing. So if your SARS income tax is under receivables or under assets, or there is a sign that indicates that the amount is on the debit side, you will then know that your SARS is no longer a liability, it is an asset. And in your calculation, you will then have to change the sign. So if it is the beginning that has been reflected under assets, it means the beginning will change to be a minus. If it is the end that is reflected under assets, it means that the end will change to be a plus. So this is the formula that is followed. Your income tax for the year, it is your income tax for the year plus beginning minus end, depending. But if you know this one, which says your SARS beginning is a plus and your SARS end is a minus, if everything is under liability, it will be easy. Well, because if you see another thing, you will then simply just change the sign. So let us look at the income tax for the year as to how much is the income tax for this year, because we want to calculate the amount, the exact amount that was paid to SARS. If you look at the information that is given here in our question 2, if you go to the following page, there is information A there. And that information A is an extract from the income statement. But then unfortunately, if you look at the accounts that are given there, the income tax for the year is not given. But we are given the net profit before tax and also the net profit after tax. Therefore, the difference between those two amounts will then be your income tax. So let us then do calculations here. Your net profit before tax is 1,777,000. 1,777,000. And your net profit after tax is minus, it is 1,243,900. So the difference between the net profit before tax and the net profit after tax will give you your income tax for the year. So therefore the income tax for the year is 533,100. This is our income tax for this year. Our income tax for the current financial year is 533. But remember, we want to calculate the exact amount that was paid to SARS. Because it may happen that the tax is 533,100, but you did not pay that 533,100. So let us then look at the amount we were owing SARS at the beginning and the amount owed to SARS at the end. If you go to information B, your SARS income tax account for the beginning and the end is reflected under liabilities, which then goes back to the formula I've just given you, that if everything is reflected under liabilities, your beginning will be a plus and your end will be a minus. So it means we were owing, the opening balance was a liability and the closing balance is still a liability. At the beginning of the year, we were owing SARS 69,300. So let us add the 69,300. 533,100 plus 69,300. If you can just quickly take your calculator, because I want you to look at something so that you may understand this calculation. If the tax for this year is 533,100, and then we were owing SARS at the beginning of the year 69,300, it means we were supposed to give what is due to SARS at the beginning of the year, which is 69,300, and also pay the income tax for the current financial year. So it means the total amount that should have been paid to SARS is 533,100 plus the amount that we were owing at the beginning, which is 69,300. So the total amount that was supposed to be paid to SARS was 602,400. But for the mere fact that there is a balance that we are still owing at the end to SARS, which is 19,800, it means we did not pay this full amount of 602,000. And hence, that is why we are following this formula, that we need to subtract the amount owing at the end. if we subtract the amount that we are owing at the end, which is 19,800, then we will get the exact amount which was paid to SARS, the income tax paid. So it will then be this 602,400 minus the 19,800. And the total amount is 582,600. So the exact amount that was paid to SARS is 582,000. Remember, when we are doing the cash flow statement, we want to calculate the exact amount that was paid. And this amount, when it is reflected under the cash flow, it will have to be put in brackets because it is an outflow. But and remember, when you are writing it in the cash flow statement and do not indicate brackets, it will then be marked wrong because the cash flow statement must indicate the inflow and the outflow of cash. But if you did not include brackets in this calculation, it doesn't matter, it may be marked correctly, but it is important that when you are putting it in the cash flow statement, it should be in brackets. So the total amount paid to SARS is 582,600. And now we are proceeding to dividends paid. According to question 2, we are required to calculate dividends paid for 4 months. And there are 2 things that we pay normally for dividends. We pay for dividends due at the beginning, which is shareholders for dividends at the beginning, the amount that we are owing for the previous year, which is our shareholders for dividends at the beginning, plus our interim. Because the final dividend is declared in the current year and paid in the following year. So it means, let's say the business is starting this year. We are starting this year to operate. It means the dividends that we can pay, because there are 2 dividends per annum. It is the interim dividend and the final dividend. It will mean that in the current year we will only pay the interim dividend, because the final dividend will be declared towards the end and will be paid in the following year. And then in the following year, the final dividend will then be the amount owing at the beginning plus the interim. So what we are therefore saying is that if you look at our calculations here, if we look at the shareholders for dividends at the beginning, it is given in information B. Our shareholders for dividends at the beginning, the amount that we were owing shareholders at the beginning of the year was 247,500, which is the final dividend for the previous year. And therefore we need to pay interim dividend for this year, because the final dividend for the current year will not be paid in the current year, it will be paid in the following year. So we will only be paying the amount owing at the beginning plus our interim dividend. But when you look at information D, unfortunately the interim dividend was not given. The transaction was only saying an interim dividend was paid on the 31st of August 2020. And if it was paid on the 31st of August 2020, we are not told whether it was 10 cents per share or that the transaction is just completely silent. But the final dividend, we are told that it was 20 cents per share was declared on 28th. But remember, the final dividend, we do not pay it in the current year. So now we need to get the interim dividend. And the only clue that is given to us here is the total dividends for the year. The total dividends for the year amounted to 835,000. The total dividends for the year amounted to 835,000. These are the total dividends. These are the total dividends. And we know that the total dividends are made up of interim plus what? Plus the final dividend. And fortunately, we do have the final dividend, which is shown as shareholders for dividends at the end. The final dividend is 340,000. The final dividend is 340,000. So now, if we know that the total dividend is made up of interim plus final, so it will then be easy for us to calculate how much is the interim when the final is given. It will just simply be 835,000 minus the 340,000, which will then give us 495,000. Our interim is 495,000. So this calculation, you can just do it here. you may decide to just add the interim of 495,000 in this calculation, or you may just add the total dividends as given, which is 835,000, but subtract the final of 340,000. You will get the same answer. So 247,000. It is 247,500. 247,500 plus 835,000 minus 340,000. And the answer is 742,500. The answer is 742,500. 742,500, which is our dividends paid. And if one has worked it out separately to calculate the interim, then you can just then come here, take your opening balance plus your interim. It will give you the same amount. If you can take this 247,500 and you just add the interim only, which is 495,000. 495,000. The total answer will be 742,000, which is the same answer that we have already calculated. And this is dividends paid. So you should always remember that your calculation for dividends paid should be your shareholders for dividends at the beginning plus your interim. And should it happen that you are not given interim, you are given the total dividends, it will then be your shareholders for dividends at the beginning plus your total dividends, and you will then have to subtract the final dividend. Because we know that the total dividends is made up of interim and final. So, but if you are given the interim, it will be very easy. It will be your shareholders for dividends plus your interim, and then the answer will be your dividends paid. And then the following question, under question 2, will be to prepare the following sections of the cash flow statement. So this one, we will just have a discussion on these aspects on the left-hand side, the details, the cash effects of financing activities. And the cash effects of financing activities, there are things that goes under there. You will have your proceeds from the shares issued, you will have your funds used to repurchase shares, and you will have your change in loan. Remember, the cash flow statement is made up of 3 stages. There are 3 stages there. There is cash flows from operating activities, there is cash flows from investing activities, and there is also cash flows from financing activities. So the operating activities, they are straightforward because there is cash generated from operating activities. But the investing activities, what normally poses a challenge to most of the learners is when they do not know the details. But what is it that will go under the investing activities? So under investing activities, how does the company invest money? The company invests money by buying fixed assets. And we know that the fixed assets are your land and buildings, your vehicles, your equipment. So the company invests money by buying fixed assets. So in as much as we buy fixed assets, we sometimes be confronted with a situation whereby we need to sell one of the fixed assets. And we also invest money in the fixed deposit. So hence we will have 3 things that will go under the investing activities. We will have the purchase of fixed assets, the sale of fixed assets, and you will also have investment in fixed deposit. And how is the company financed? That is cash effect of financing activities. The company is mainly financed by the shares, the issuing of shares, and secondly, when that money that we get from the sale of shares is not enough, we then take out loans. So that is why under financing activities, you will have your proceeds from shares issued, you will have your funds used to repurchase shares, and you will have your change in loan.
All right, good day everyone. We are still doing the very same question paper, which is accounting grade 12, November 2022. For us to be able to continue with this, may I request that you all take out the question paper so that When I refer you to the question paper, you will be able to see where I am reading. So we are doing November 2022 Accounting National Senior Certificate, and we are continuing where we ended. We have already started doing 2.1, and today we are continuing to 2.2, Usanda Limited. 2.2.1 has already been done, and we are starting on 2.2.2. This question is based on financial indicators and cash flow statement. And 2.2.2, we are required to prepare the following sections of the cash flow statement. So this question does not require that we do the complete cash flow statement, but we are requested to complete the certain sections of the cash flow statement. So what is required is the cash effects for financing activities, and the second one is net change in cash and cash equivalents. Cash effects of financing activities is 11 marks, as you can see there on page 6 of your question paper, and net change in cash and cash equivalents is 4 marks. Right, but it is important that you know the complete structure of the cash flow statement, because you may never know which section they may test in the examination. So you should know that the cash flow statement has got cash flows from operating activities, wherein we are having the cash generated from operations. You have your interest paid, you have your dividends paid, you have your taxation paid. And then you have the second, which is the cash flows from investing activities. And investing activities, how does the company invest money? That is where we have our purchase of fixed assets, our sale of fixed assets, and we also have proceeds from fixed deposit, investment in fixed deposit. That is cash flows from investing activities. And then you also have the cash effects of financing activities. Financing activities. Under financing activities, you have your proceeds from the issue of shares. Proceeds from the issue of shares, whereby the company is selling shares to raise funds for the business. And once a person has purchased shares from the company, that person automatically becomes the shareholder in the company. So you have the proceeds from the issue of shares, that is the main source of finance for the company. But you do find that there is a situation whereby some of the shareholders are no longer happy to be the members of the company and they want to leave. And then the company has to buy back those shares. So that is why we are also having the repurchase of shares. The repurchase of shares. So in as much as we have the issuing of shares, we also have the buyback of shares. When we sell shares, that person who buys shares from us is given a special name, then it is now called a shareholder. But when that shareholder is no longer happy to be part of the company, he may request that the company may buy back those shares from him or her. So we call that the repurchase of shares. And then the last section of the financing activities will be your change of loan. It will be your change of loan. So the company is mainly financed by shares and loans. If the money that we raised from the shares is not enough, we therefore consider going for an option of a loan. So when we are looking at the financing activities, we are looking at these 3 sections: proceeds from the issue of shares, repurchase of shares, and change in loan. So let us then go to our question paper and open on page 7, where we are looking at the information that will assist us to answer this question. When you go to page 7, you will notice that there is information A there is information B, and there is information C. There is information C which talks about shares. There is share capital there. We are told that on the 1st of March 2020, which is the beginning of the accounting period, the number of shares issued was 1,650,000 shares in issue. And then on the 30th of October 2020, 50,000 additional shares were issued. But the challenge with this transaction is that we are told the number of shares that we have sold in the account during this accounting period, but the price at which shares were issued is not given. Hence, we do not have the amount for the proceeds from the issue of shares. So when you are confronted with a situation like that, it therefore becomes important that you prepare a share capital note in your rough work. You prepare a share capital. The share capital note will then assist you to get the amount that is not given. So let us then follow this transaction and do this share capital note together here on the board. On the 1st of March, that's the beginning of the accounting period, the company had 1,650,000 shares in issue. 1,650,000 shares in issue. And then on the 30th of October 2020, 50,000 additional shares were issued. So we issued another 50,000. 50,000 additional shares were issued. And then the total dividends for the year amounted to 835,000. That is for dividends. And then on the 27th of February 2021, 335,000 shares were repurchased at R9.50. 335,000 shares were repurchased at R9.50. And then on the last day of the accounting period, we have 1,365,000 shares in issue. Last day of the accounting period, we have 1,365,000 shares in issue. How did they arrive at this 1,365,000 shares? It is 1,650,000 shares in issue at the beginning, plus additional shares that were issued, which is 50,000, minus 335,000 shares that were repurchased, and then the total number of shares in issue at the end is 1,365,000. And let us then go to the amounts. We do have the amount for share capital at the beginning and the amount for share capital at the end. It is given there in information B. When you look at your information B, there is ordinary share capital there. I think it is number 1, 2, 3, 4, 5, 6, 7. It is number 7 there under information B. You have your ordinary share capital there, and your ordinary share capital at the beginning of the year was 11,220,000. Your ordinary share capital was 11,220,000. And your ordinary share capital at the end is 9,555,000. It is 9,555,000. These capital amounts were given. So now we then have to go to our calculators and do some calculations. Remember, the buyback of shares, we do not use the price that is given in the book here to calculate the total amount for shares repurchased when we are doing the share capital note. When we do the share capital note, the price for shares repurchased that we use is the average issue price. Now, in most cases, the average issue price is calculated using the amounts at the beginning. But you can't calculate using these two amounts because there is a figure that is missing here for additional shares issued. Hence, it is allowed that in accounting, if there is an amount that is missing on top, you may use the amounts at the end to calculate the average issue price. So let us then calculate the average issue price. The average issue price, the formula of calculating the average issue price will be your capital divided by your number of shares issued. So our capital is 9,555,000. 9,555,000 divided by 1,365,000, which give us 7 rand. So the average issue price is 7 rand, we are assuming that these shares were sold for 7 rand. It's just an average issue price. How do you get the average issue price? It is by taking your capital and dividing it by the number of shares issued. It's like saying that if you want to calculate, let's say you bought cakes for 50 rands and the total number of cakes that you bought is 25. So if you want to calculate the average price for each cake, you will then say 50 divided by 25 to get the 2 rand, which will be your average purchase price. Same thing applies with our capital. We just want to get the average issue price. How much were these shares sold for? So if you look at the average issue price, we are taking our capital and dividing it by the number of shares issued. So the average issue price is 7 rand. So let us then calculate the repurchase price. It will then be 335,000. 335,000 multiplied by 7 rand. 335,000 multiplied by 7 rand, and you have your 2,345,000. And remember, these amounts for the repurchase, it should be in brackets, because when we are buying back shares, our capital decreases. But when we are selling shares, our capital increases. Remember, the company sells shares in order to raise more capital. So when the company is issuing more shares, the capital increases. But when we are buying back shares, our capital decreases. And that is why these amounts are shown in bracket. So now that we had these additional shares that were issued and the price was not given, now that we have already prepared the share capital note, we can be able to find out how much is the missing amount here, because there is only one amount that is missing. How can we find out? Is that we need to just work backwards. You have your 955,000 rands, and if you are calculating backwards, like by reversing, remember when you are reversing with the calculations, your signs will change. So you will have your 9 million, you will have your 9 million if you are working backwards. You have your 9,555,000, 9,555,000, and then this sign will change. Because it's a minus, it will change to be a plus. 9,555,000 plus 2,345,000. 2,345,000 minus, this one is positive, so because we are reversing, it will change to be a minus. Minus 11,220,000. 11,220,000. This equals to 680,000. The missing amount here is 680,000. The additional shares that were issued during the year, the amount that we receive out of that sale is 680,000. So therefore, the amount that needs to be here for the proceeds from the issue of shares is 680,000. And you need to write down, you need to show your calculations. Your calculations, it's 9,555,000, and that is plus 2,345,000 minus 11,220,000, and that will give you your 680,000. So what you need to know from this, if you have a challenge, you are given the total number of shares issued, but the price is not given, it is important that you need to draft the share capital note in your rough work, because there's no way by which you can be able to get the amount if it is not missing. Because you can see that here, this 680,000 has now become a balancing figure. So there was no way we can be able to get the 680,000 without drafting the share capital note, right? And then the repurchase of shares. When you look at the transaction, the repurchase of shares, the price was given. It's just that when you are doing the share capital note, you don't use the price that is given here. You just have to calculate the average. But in the cash flow statement, you use the price, the full amount. The full amount, it says here, 335,000 shares were repurchased at 9 rand 50. So you have your 335,000 shares multiplied by 9 rand 50. This information was given in the question paper. 335,000 multiplied by 9 rand 50. And one will have a question as to why are we using 7 rand here and we are using 9 rand 50 here. The full amount that we paid for the buyback of shares is 9 rand 50. But here, when we are doing the share capital note, we can't take out the 9 rand 50. We use the 7 rand, the price at which the shares were sold. Because if we can take out 9 rand 50 from here, because you can see now that this shareholder who is leaving has added something. There is a price above the average issue price. He has added 2 rand 50 because these shares were originally issued at 7 rand. So we are now calculating the total amount that is going to be paid to these shareholders. It is 335,000 multiplied by 9 rand 50. The shares were originally issued for 7 rand and we are now buying each share for 9 rand 50. There is 2 rand 50 above the average issue price. So it will be 335,000 multiplied by 9 rand 50 equals to 3 million. 335 multiplied by 9 rand 50 equals to 3,182,500. So it is 3,182,500, and this amount must be in brackets. It must be in brackets as it indicates an outflow of cash. We are buying back these shares, so we are paying 3,182,000. But this one, which is 680,000, we are selling shares and we are receiving cash. Remember, the cash flow statement is about the inflows and the outflows of cash. So if we are receiving money, that money must be shown as a positive amount to indicate an inflow. But if we are paying, that money must be shown in brackets to indicate an outflow of cash. So let us then go to our question paper and look at the change in loan. Did we have the inflow of cash or did we have an outflow of cash? Let's look at our loan. When you go to information B again, the loan at the beginning is given, which is 2,080,000. The loan was 2,080,000. That is information B in your question paper, which is on page 7. The loan was 2,080,000. But if you look at the end of the financial year, the balance on the loan is not given. Again, this is another challenge. Remember, the cash flow statement is a high order question, so you are advised to make sure that you practice these activities on regular basis so you get used to the challenges that you face when you are doing the cash flow statement. But if you look at this one, the beginning, the opening amount for loan is 2,080,000 and the closing amount was not given, and we are then instructed that we need to see information E. And when you go to information E, there is a balance, there is an opening balance there is given. The opening balance for loan is 2,080,000. 2,080,000, that's the opening balance in information E. And the monthly installment of 35,000 including interest were paid. The monthly installment of 35,000. If it is 35,000 per month, that will be 35,000 multiplied by 12 to get the annual payment. 35,000 multiplied by 12. So the total amount that we have paid in this loan, because we want to calculate the closing balance as it is not given here. The total amount paid during the year in this loan account is 420,000, which should then reduce the balance of the loan. If we are paying, the loan balance should then decrease. So we have paid for the whole year, we have paid a total of 420,000. And then we are told that the interest capitalized amounted to 270,000. There is also an interest on loan which amounted to 270,000. The interest will increase the loan. So let us then calculate the closing balance in our loan account. You have your 2,080,000 opening balance, 2,080,000 as the opening balance, minus our payments for the whole year, which is 420,000, plus 270,000 interest that is added. So therefore, the closing balance is 1,930,000. The closing balance is 1,930,000. So now we have the opening balance and the closing balance. The opening balance was 2,080,000. 2,080,000. And the closing balance, because we want to calculate the difference, how much the total amount paid. So we have 2,080,000 minus the closing balance, which is 1,930,000. We want to calculate the change in loan. The change in loan by comparing the opening balance and the closing balance. So the change in loan will be 2,080,000, 2,080,000 minus 1,930,000 minus 1,930,000. So the change in loan is 150,000. And there is a clear indication now that the loan has decreased. That indicates that we have paid. The change is that we have paid. We did not take a new loan, but we have paid. So it was 2,080,000 at the beginning of the accounting period, but now at the end of the accounting period it is 1 million, and that is a change of 150,000. And because we were paying, so it means this 150,000 is an outflow of cash. An increase in loan, if the loan is increasing, it means that we have taken another loan and therefore we have received money, then that will be an inflow of cash. So the amount will not be in brackets. But if the loan is decreasing, that is indicating that we have paid, and as a result, this 150,000 is reflected as an outflow of cash. So you have these three financing activities, which is the proceeds, and they need to be combined together in the box. That's where you need to draw a box here, where you are combining, because we now want to come up with the total for the financing activities. We now want to come up with the total for the financing activities. So you have your 680,000 for the issue of shares, minus the buyback of 3,182,000, 3,182,500. That's 3,182,500. Calculation: 680,000 minus 3,182,500. 3,182,500 minus 150,000. 2,652,500. You have your negative 2,652,500. You have your 2,652,500, which is negative. So if it is a negative amount, then it must be shown in brackets. So that is your total for the cash effects of financing activities. So you should always remember that when you are doing the financing activities, just because these details will not be given, this proceeds from the issue of shares, sometimes these details are not given. You will just be given the cash effects of financing activities, and you will be required to fill in the details and show the calculation. So it is important to remember that the company is mainly financed by shares. When we are issuing shares, that is where we get most of our funds. But if that money that we obtained from the issuing of shares is not enough, we then look for another option wherein we need to take a loan. So that is why under financing activities, you will have the proceeds from the issue of shares, the repurchase of shares, and the change in loan. Right, let us then proceed to another section, which is net change in cash and cash equivalents. We want to calculate the net change in cash and cash equivalents by looking at our cash opening balance and our cash closing balance. So that information will again be obtained from our question paper. When we go straight to page 7 and we are looking at the question paper there, we are looking for cash and cash equivalents. We want to calculate the change. So let's start with the opening balance. The opening balance will be under February 2020, and your closing balance will be under 28 February 2021. So your opening balance for cash and cash equivalents here, it was 154,700 in 2020. But when you go down, still on information B, it is showing that we have an overdraft. We have a bank overdraft of 90,000. We have a bank overdraft of 90,000. We have cash that is available, which is 154,000, the positive balance of 154,700. But again, at the same time, we are owing the bank 90,000. We have a bank overdraft of 90,000. So we need to subtract this 90,000 so that we come up with one amount. So if we have to pay this 90,000, then it will mean that the opening balance is how much? 154,700 minus the 90,000 bank overdraft. 154,700 minus the overdraft of 90,000, bank overdraft. Bank overdraft, I'm sure we are all familiar with bank overdraft. Bank overdraft occurs when you withdraw more than you have in the bank. But not all accounts will allow for that. The bank overdraft is only allowed to current accounts. When you have a current account, which is formerly known as check account, and you need to apply for it. Then if you have applied for a bank overdraft and the bank has approved you, then you will have an allowance that even if you run out of cash in your account, you will still be able to withdraw from your account, and by so doing you will then be taking a bank overdraft. So let's say if you have a balance of 10,000 and you want to withdraw 30,000 and you have an overdraft facility in your account, it will mean that if you withdraw 30,000 and you have a positive balance of 10,000, then you will be doing an overdraft of 20,000 rand. So 154,700 minus 90,000. So it then gives us the opening balance of 64,700. The opening balance, cash opening balance is 64,700. And then the closing balance, information B, cash and cash equivalents, 28 February 2021. The closing balance is 120,700, and there was no bank overdraft. Closing balance is 120,700, and there was no overdraft. So all that we need to do now is just to work backwards so that we are able to get the net change. We just have to calculate, reverse this, and then we are able to get the net change. So we have 120,700. Remember, when you are working backwards, your sign will then change, because this 64,700 is positive. When you are working backwards, it will be 120,700 minus 64,700 minus 64,700, and that will give you 56,000. So our net change is 56,000. The net change is calculated. Even if you are required to calculate the net change and this format is not given, you may as well just draw it in your answer sheet. If you are given just a blank column space, you must just draw it like this, because if you are not calculating the net change using this format of working backwards, the chances of getting the wrong amount, they are very likely. So this format, you should always use this format whereby the net change, you start with the net change, you have your cash opening balance, and you have your cash closing balance. You start by filling in your cash opening balance as it is given and in most cases, you must make sure that when you are looking at your cash and cash equivalents, is there any, you must also check down there, is there any overdraft in that particular year? If there is an overdraft, then that overdraft must be subtracted. Like in this case here, at the beginning of the year, there was an overdraft of 90,000. But at the end of the year, when you look at the space for an overdraft, there is 0. So which then tells us we just take the amount as it is, which is 120,700. So you start by filling in the opening balance, you're filling in the closing balance, and then you work backwards. Then you will get the net change, which is 100% correct. Right. Let us then go back to the question and see. So we are done with question 2.2.2, which was 15 marks. Cash effects for financing activities and net change in cash. We are on page 6. We are on page 6. So we are now proceeding to question 2.2.3. Page 6, it is where we are given the questions, and page 7, that is where we get the information that we are using. So if we are now referring to page 6 and 2.2.3, we are required to calculate the following financial indicators for the year ended 28 February 2021. That's 2.2.3. 2.2.3. Let's use the space. 2.2.3. These are financial indicators. The first one that we are required to calculate, the analysis and interpretation of financial statement. The first one that we are required is percentage operating profit on sales. Percentage operating profit on sales. Percentage operating profit on sales. So you are now fortunate that when you are sitting for your examinations, the formulas are now provided. In the previous years, the formulas were not provided. So, but now, when you sit for your final examination, you will notice that at the back of your question paper, there are formulas that are provided. But you will just have formulas, and they do not tell you that this formula belongs to this calculation, to this ratio, or this formula is for this. So it is important that in as much as the formulas will be provided, but you need to know the formulas by heart. As for this one, the formula will be very easy, because if it says percentage operating profit on sales, your formula will be operating profit over sales. If you are required to calculate percentage operating profit on cost of sales, your formula will be operating profit over cost of sales. If you are required to calculate operating expenses on sales, your formula will be operating expenses over sales. So in this case, you are required to calculate percentage operating profit on sales. So our formula is operating profit over sales. So our operating profit, let's go to page 7, information A. Our operating profit is given there. It is 2,262,100. Our operating profit is 2,262,100. This is our operating profit. It is given in information A, 2,262,100. And then our sales, our operating profit, and then our sales is 17,800,000. 17,800,000 over sales of 17,800,000 multiplied by 100. 2,262,100. That's 2,262,100 over 17 million, 2,262,100 over 17,800,000. 17,800,000 multiplied by 100. And then the percentage is 12.7%. So the answer is 12.7%. Our operating profit on sales is 12.7%. So that is our operating profit on sales. And the following one that we are required to calculate is the asset test ratio. Asset test ratio. What is it that we are? This ratio, asset test ratio, it falls under liquidity ratios. The ability of the company to pay for the short-term debts. The asset test ratio. The asset test ratio is one of the ratios that falls under liquidity. If you are required maybe to define liquidity, liquidity refers to the ability of the business to pay for the current debts. We want to assess if the business can be able to pay for the current debt. So here we are required to calculate the asset test ratio. And the formula for this one is very simple. You have your current assets minus inventory is to current liabilities. Current assets. What is it that we are assessing here? Remember, your current assets is made up of three things. Your current asset is made up of inventory, which is stock that needs to be sold. It is made up of cash that is in the bank. It is also made up of cash that is still with the debtors, people who are owing us. So cash that is with the debtors, it is money that we can claim because they have already purchased from us. So it is somehow is money that we guarantee that it is ours. And cash that is in the bank is also our cash that is also guaranteed that is ours. But with regards to stock, we cannot guarantee that the stock will be sold. So here, by doing the asset test ratio, the business wants to assess that in the event that the stock may not be sold, or maybe there can be a new competitor who is selling the same product as ours, can this business still survive? So that is why we are taking all the money that is in the current assets. And the current asset is made up of inventory, which is our stock, our cash in the bank, and the cash that is with the debtors. That is current assets. So the cash that is with the debtors is guaranteed to be ours. We can claim it. Cash in the bank is guaranteed that it is ours because we keep it in the bank. But as for inventory, inventory is not guaranteed that it can be sold because we don't know, anything can happen. We might have a competitor that might come out and sell the same product, and you'll find that the stock, our stock, will end up lying there and it is not sold. So we want to check that should the stock not be sold, can we still be able to pay for the current liabilities? So let's look at our total assets combined, current assets. Let's look at our current assets. Our current assets, the amount is 659,500. The total amount is 659,500. Remember, in this total is made up of stock of 276,500, trade and other receivables, which is our debtors of 262,300, and our cash of 127,000. And all those three items combined, they are giving 659,500. So now we are saying, let's just take out stock from this amount and see, can we still be able to pay for the current liabilities even if the stock cannot be sold? The value of stock is 276,500 minus 276,500 is to current liabilities. Our current liabilities, they are there. The total amount for current liabilities is 611,000 900. Current liabilities 611,900. Right. So let us then look at the final answer. So 659,500 minus, that is 659,500, yes, that's the correct amount, minus our inventories, which is 276,500. That gives us a total of 383,000. That's 300. You may write this step, or you may decide to skip this step and just shoot straight to the final answer. It's up to you. So it's 659,000, 59,500. Let's confirm the amount once more. Minus 659,500 minus 276,500. That's 383. Okay, that's correct. So 383,000 divided by 611,900. 383,000 divided by 611,000. 611,900. That gives us 0.6. 383,000 divided by 611,000, that is giving us 0.6. So the answer here is 0.6 is to 1. That is 0.6 is to 1, which then tells us that this business might be in a serious trouble if the stock is not sold. You can even look at the amounts. The current liabilities are totaling at 611,900, but our current assets, if we are taking out inventory, the total is 383. So these current assets of 383 cannot be able to cover this current liabilities of 600 if the stock cannot be sold. So it means this business has to make sure that the stock is sold, because the total of 659,500, it means the amount that is contributing a lot to this total is for the stock. So should the stock not be sold, then the business will be in trouble in terms of how are they going to pay for their current liabilities. Right? Let us then proceed to another calculation. Another calculation is ROSHE, the percentage return on average shareholders' equity. ROSHE. ROSHE is an accepted abbreviation. ROSHE, the percentage return on average shareholders' equity. ROSHE, and the formula, it is net profit after tax. Net profit after tax. Remember, I told you that you need to know the formulas. It is net profit after tax over average shareholders' equity. And there is no need to write the formula in the exam. There is no need to write you just need to go straight to the calculation. But I'm just writing it now to make sure that you are familiar with the formula and you understand the formula. So it is net profit after tax. This is the return on average shareholders' equity, where the formula says net profit after tax over average shareholders' equity. So if you look at information A, page 7, the net profit after tax was provided, which is 1,243,900. It's 1,243,900. Net profit after tax 1,243,900 over the average shareholders' equity. We must take the shareholders' equity at the beginning, which is 11,985,000. 11,985,000 plus shareholders' equity at the end, which is 9 million. Shareholders' equity at the end is 9,891,400. 9,891,400. You add these two figures and you divide them by 2. Multiply by 100. The average. If you are calculating the average, you take the beginning and you add it to the end, equal sign, and then you divide it by 2. So the average shareholders equity, so you have your net profit after tax, which is 1,243,900 over, let's calculate the average shareholders equity. The shareholders, this information is given. So you can see that when calculating these ratios and percentages, all you need to know and fully understand are the formulas so that you are not stuck, because all other information is provided. The net profit after tax is provided in information A. The average shareholders equity, we are able to calculate it because the shareholders equity at the beginning is provided and the shareholders equity at the end. So if we want to calculate the average, you take the opening amount and the closing amount, you add them together, equal sign, and then you divide by 2. So let's calculate the average. 11,985,000. That's 11,985,000. 11,985,000 plus 11,985,000 plus 9,891,400. 9,891,400 equals to, and then you divide that by 2. That will give you 10,938,200. 10,938,200 multiplied by 100. 10,938,200. Let's just verify this. It's important that we make sure that we are doing the right calculations. 11,985,000. Just want to verify it again. And then plus 9,891,400. 9,891,400. 9,891,400 equals 2 and divide by 2. Yes. 10,938,200 is the correct average shareholders equity. So let's then calculate the percentage. The percentage will be 1,243,000, 1,243,900 divided by 1,243,900 divided by 10,938,200. 10,938,200 multiplied by 100, and then it is 11.37. If it is 11.37, we can take that as 11.4, because this number we are rounding off. It is 11.37, so that's just 11.4%. 11.4%. So our percentage return on average shareholders equity is 11.4%. Remember, in most cases, this percentage return is compared to an alternative investment. The shareholders, they are very much interested on this percentage return on average shareholders equity because they want to look at their return. Would I have invested in this company, and this is the percentage return that I'm getting. If I'm getting 11.4%, this is very close to an investment in fixed deposit of 10%. So the shareholder may decide, no, I am not happy with this return. I am taking my money and I'm deciding to invest it in the fixed deposit. So in most cases, this ratio, this percentage return on average shareholders equity is compared to an alternative investment. And the alternative investment, which is fixed deposit. So this is percentage return on average shareholders equity. Let's look at the last one. The last one that we were required to calculate was dividend payout rate. Dividend payout rate. Dividend payout rate. And then the formula of calculating a dividend payout rate, it is DPS, which is dividends per share, over, it's DPS, which is dividends per share, over EPS, multiplied by 100. DPS over EPS multiplied by 100. Then you can get the dividend payout rate, what is the dividend payout rate for this year. So like if you look at this question, this was question 2 from November 2022 exam. This question, when you go to information D on page 7, the earnings per share is given there is 74 cents. Earnings per share, we don't have a problem with earnings per share, it is given. Information D, last bullet, it says earnings per share on 28 February 2021 was 74 cents. So the earnings per share was 74 cents. The only thing that was not given there is interim dividend per share. Because remember, the total DPS should be made up of two things. It should be interim plus final. So we are only having the final. The final dividend here is 20 cents per share, but the interim is not given. So we are having a challenge on this one. So that is when we need to look at the information that can be able to assist us to get the interim. There is a transaction in information D bullet 3 which gives us the total dividend. The total dividend is 835,000. The total dividends is 835,000. That's the total dividends. And we know that the total dividends is made up of final and interim. This total of 835,000 is made up of interim plus final. And the final dividend amount is there. Shareholders for dividends at the end, information B, last account there, information B. The shareholders for dividends on 28 February 2021 of 340,000. That is final dividend, 340,000. The final dividend is 340,000, which then tells us how much is the interim. We can be able to calculate the interim now. We can calculate the interim. We can just say 835,000 minus 835,000 minus 340,000. So our interim dividend is 495,000. But we don't want the total amount for the interim dividend. We want to calculate the interim dividend per share. So we need to check how much was the total number of shares, how many shares were issued, what was the total number of shares issued when we paid the interim dividend, so that we are able to calculate the interim dividend per share. And when we are tracing it, looking at the transactions there, you can see that the interim dividend was paid on the 31st of August 2020. And then at the start of the accounting period, we had 1,650,000 shares in issue. And the change was on the 30th of October. The change was after. So we issued the interim dividend. The interim dividend was paid before this change. So which then tells us if the interim dividend was paid on the 31st of August and the change was on the 30th of October, it then tells us that the interim dividend was paid while the shares were still at 1,650,000. So the total number of shares in issue was 1,650,000 shares. So it will then be 495,000 if we want to calculate dividends per share. 495,000, which is the total dividends, divided by the total number of shares in issue when we paid the interim dividend, which was 1,650,000. And then we can see that it was 0.3 which is 30 cents. 0.3, which is 30 cents. This is 30 cents. 30 cents. So the interim is 30 cents and the final is 20 cents. So you have your interim at 30 cents plus your final at 20 cents, which then equals to 50 over 74 multiplied by 100. Your interim is 30 cents because your DPS is made up of interim plus final. So we have a total of 50. So that is 50 divided by 74 multiplied by 100. 50 divided by 74 multiplied by 100. So that is 67.5. That is 67.5. 67.5%. Or you can try 67.6% if you round it off, because there is 5, 6. 67.5 may be accepted and 67.6%. 67.6%. So the dividend payout rate for the current year is 67.6%. So this brings us to the end of question 2, which was based on financial indicators and cash flow statement. So just a quick recap. We want to emphasize that this question is one of those high order questions, but they are not difficult. So a student is encouraged to ensure that you go through these questions repeatedly so that you get used to the way how to answer such questions, so that you get used even to the questioning method in these questions so that you are able to solve them. So this is the end of question 2. Thank you.
Okay, good morning everyone. Welcome to this accounting lesson for today. Today I have decided that we do an accounting past exam paper, which is taken from November 2020. It's accounting paper 1, November 2022 exam. The question that I decided that we need to start with is question 3. May I request that you all take out your November 2020 paper 1 question papers so that you may see whatever that we are discussing from your question papers. The question that I'm going to be starting with is question 3. Why specifically question 3 is that the observation from the past results, it has shown that most of the students are not doing well in these questions which requires interpretation. So question 3 is basically interpretation of financial statements, and unfortunately most students, they were used to doing accounting calculations only, but accounting has now changed. We now have interpretation of financial statement where one is required to interpret, analyze, and make sure that the decisions that are taken are financially informed and they are well calculated. Question 3.1, it says choose the question from column B that matches a category of financial indicators in column A. Write only the letter A to E next to the question numbers 3.1.1 to 3.1.4 in the answer. So we have got 4 questions here. And there are 4 accounting concepts. There is liquidity, there is risk and gearing, there is return to shareholders, and operating efficiency. So liquidity, which is 3.1.1, it matches with a description in column B, which is, if you look at the options that are given here, there is an option which is option C, which says liquidity. Will the company be able to pay off its current debts? I hope you all remember that there is liquidity and solvency. Solvency deals with the ability of the company to pay for the total debts, but liquidity deals with only the current debts. Remember, the total debts are made up of current debts plus non-current debts. So, but when we are looking at liquidity, we are only looking at the current debts only. So now if you look at the option C, which says will the company be able to pay off its current debts, this is the best option. This is the correct answer for 3.1.1. So the correct answer for 3.1.1, which is liquidity, will the company be able to pay off the current, that is C. And 3.1.2, risk and gearing. Risk and gearing has got to do with loans, the borrowings, the long-term borrowings of the company. So if you look at the best option for 3.1.2, it is option E, where it says how is the company managing loans or borrowed capital. So the correct answer for 3.1.2 is E. That is E. 3.1.3, we are looking at the return to shareholders. Remember, the shareholders are the owners of the company. How do you then become a shareholder in the company? You need to buy shares from the company. So now we are now looking at what is it that they are going to get in return. So the return to shareholders. So if you look at the option that is best suited for 3.1.3, it is option B in your question papers there, which says, is the investment in the company better than investing in a fixed deposit? Remember, when the shareholders are looking at their return from their investments in the company, they need to make a comparison. Is what I'm getting more than enough than what I can get if I may decide to go for a fixed deposit? So the return on investment, so this option, which is option B, is a better option, or is the correct answer for 3.1.3, the return to shareholders. And then 3.1.4, we are looking at the operating efficiency. Is the business managing expenses effectively to increase profitability? That is operating efficiency. So therefore, the best option for 3.1.4 is option A, which says, is the business managing expenses effectively to increase profitability? That is 3.1.4, that is A. So if we re-look at the answer to 3.1.1 is C, 3.1.2 is E, 3.1.3 is B, and 3.1.4 is A. And that gives you a total of 4 marks. Right, we are now proceeding to question 3.2, which is Sci-Fi Greeks Limited. The business trades in electronic equipment purchased from China. The information relates to the past 2 financial years, and at 31st March, the COVID-19 lockdown has negatively affected sales over the current financial year. So we are required here. We are required 3.2.1, liquidity. The directors are satisfied with the improvement in the current ratio and the asset test ratio. Explain why you would disagree with them. Quote 2 financial indicators in your response. So liquidity, remember liquidity, we have got quite a number of ratios or financial indicators which falls under liquidity. There is current ratio, there is asset test ratio, there is stock turnover rate, there is average debtors collection period, there is average creditors payment period, there is stock holding period. So now if you look at this question, which is 3.2.1, it says the directors are satisfied with the improvement in the current ratio and the asset test ratio. So they are looking at liquidity only in 2 ratios, which is current ratio and the asset test ratio, of which there are quite a number of financial indicators which falls under liquidity. So we need to look deep as to why we will agree, we will disagree with them. Explain why you will disagree with them. If you look at information A in your question paper there is current ratio which is given there, and current ratio improved from 1,1 is to 1 to 2,4 is to 1, which is not a very good improvement. Stockhold asset test ratio improved from 0.4 is to 1 to 1.0 is to 1, which is an improvement of 0.6. But if we have to quote other financial indicators, that will make us to disagree with the directors, is the stock holding period. If you look at the stock holding period, the stock holding period, because we don't want to only focus on the current ratio and asset test ratio and then claim that there is an improvement in the liquidity position of the business, the ability of the business to pay for the current debts, for the short-term debts. If you look at the stock holding period, the stock holding period increased from 32 days to 102 days. The stock holding period increased from 32 days to 102 days, which is not good for a business. We don't want a situation whereby the business will keep stock for such a long period of time. If you look at the increase, the stock holding period was 32 days at the beginning of the year, and now we are closing with 102 days. So the stock holding period has increased, which may then result to what? This may result to stockpiling. We don't want a situation whereby there is too much cash which is tied up in stock. So this increase may result to, remember what can happen to a situation whereby this stock may become obsolete, or this stock the customers may no longer want. If we keep stock for too long, we are running at a risk that the stock may become obsolete, and you will find that we will no longer be able to sell that stock, and then therefore we'll then run out of cash. Another financial indicator that we may also cause to disagree with the directors about the improvements in liquidity is the average debtors collection period. Average debtors collection period. Average debtors collection period. But how do we collect our monies from the people who are owing us? If you look at the average debtors collection period, in 2020, the debtors average collection period increased from 31 days to 46 days. Average debtors collection period increased from 31 days to 46 days. The average debtors collection period increased from 31 days to 46 days, which is not good for us as the business, because if we were collecting on average from our debtors, from the people who are owing us, if we were collecting on average after 31 days, that was good for us. So now if this has increased to 46 days, it is an indication now that our debtors are now taking too long to pay us, and that may also result to the business having a liquidity problem, because we may run out of cash if our debtors are not paying us on time. Right, let us then proceed to question 3.2.2. I hope we are all clear with the liquidity one, which is 3.2.1. We are now proceeding to 3.2.2. 3.2.2 is talking about the dividends. Remember, when the shareholders buy shares from the company, their main aim is to get dividends from the company. So dividends is an income to the shareholders, but to us as the business, remember when we are doing accounting, we are on the side of the business. To us as the business, dividends is an expense. So we are looking at 3.2 where it is said here, the directors change the dividend policy from the current financial year. So the distribution of profits, because dividends is mainly the distribution of profits to the shareholders. So it was changed. The directors changed the dividend policy from the current financial year. And our first question on 3.2.2, it says, comment on the dividend per share over the 2 years, code figures. So I always advise students that you need to make sure that when you see this thing which says quote figures, it's a clear indication that the figures are provided in your question paper. So there is no need for you to leave a blank space. So if we are asked to quote figures, to comment on the dividend per share over the 2 years, it means we need to look at the dividends for 2020 and also look at the dividends for 2021. And if you look at information A again in your question paper, it is clearly indicated there that in 2020, the dividends per share was 90 cents, and in 2021, the dividends per share is now 72 cents, which is telling us that there has been a decrease. So dividends per share decreased. Dividends per share decreased from, it was dividends per share decreased from 90 cents in 2020 to 72 cents. It decreased from 90 cents to 72 cents. And you get your full marks. Because the question was just asking you to comment on the dividend per share. And this is a comment that the dividends per share, they have decreased from 90 cents in 2020 to 72 cents in 2021. And then there is a follow-up question to this one from the question paper, which says, explain the change in the dividend payout rate and give a reason for this change. Quote figures. Explain the change in the dividend payout rate and give a reason for this change. Quote figures. If you go again to your information A that is provided there, you will see that there is a dividend payout rate that has already been calculated for you. And even the change is there. If you look at 2020, the dividend payout rate was 69%. And in 2021, the dividend payout rate is now 136.5%. So the dividend payout rate increased. Dividend payout rate increased from 69% to, it increased from to 136.5%. To 136.5%. Now, this is where some of the learners get confused, because if you look at the dividends per share, the dividends per share decreased from 90 cents to 72 cents. But if you look at the payout rate increased from 69% to 136.5%. One needs to remember that when you are calculating the payout rate, it is dividends per share over earnings per share times 100. So therefore, if there is a change in the earnings per share, your dividends per share might have decreased. But if there was a change in earnings per share, you will find that your payout rate has increased. Like if you look at what is provided in information here, A here, your earnings per share, our earnings per share, let's go and search for earnings per share. Earnings per share was 130 cents in 2020, and earnings per share went down to 58 cents. So because of this decrease in the earnings per share, it then resulted to an increase in the payout rate from 69% to 136.5%. And give a reason for this change. But what might have been a reason behind the directors deciding to increase the payout rate, from 69% to 136.5%. And the reason there might be so many reasons. But if you look at the profitability of the company, if you look at the percentage net profit before tax on sales, it was 20.3% and it went down to 13.9%. The profitability of the company has decreased, which then tells us that there is something that the company is not doing well. So the reason for increasing this payout rate, it might be the directors were attempting to please the shareholders. Considering that profitability has decreased. You see, if the profitability of the company is going down, the company will be having a risk that it may lose some of the shareholders. So, in an attempt to keep the shareholders, this might the reason why the directors have decided to increase the payout rate from 69% to 136.5%, because the directors were attempting to please the shareholders, considering profitability of the company has decreased, considering that it has decreased. So they wanted to make the shareholders happy. They wanted to keep the shareholders by ensuring that they increase their dividends. Right? But there is also another point C there under 3.2.2. Point C, it says, a shareholder felt that they should be satisfied with the dividends they received, as it is better than last year. Now, this question might be a bit confusing with why the shareholder, they should be satisfied with the dividend as it is better than last year. But if you look at the dividends per share, last year it was 90 cents. And then now in the current financial year it is 72 cents. But this question is claiming that the shareholder felt that they should be satisfied with the dividends they received as it is better than last year. Explain why you agree with him. So now we have to explain why we should agree with him by quoting figures. You see, if we look at the percentage payout rate of 69%, and you look at the earnings per share, the earnings per share for the previous year was 130 cents. Let me take out my calculator so that we do calculation. I request that you all take out your calculators so that we do this calculation. So, in the previous year, this 69%, if you take the earnings per share of 130 cents, 130, and you multiply it by 69%, you will get the 90-cent dividend that was paid in the previous year. So if the company had maintained the very same 69% in the current year, if you look at the earnings per share, now that the earnings per share is 58 cents, if you look at the earnings per share, EPS of 58 cents, and you multiply it by the 69%, if you look at the earnings per share of 58 cents and you multiply, if they had kept the same percentages last year, 58 multiplied by 69 over 100, multiplied by 69%, it's 40 cents. So dividends per share for the current year could have been 40 cents if they had kept the 69% from last year. So that is why we are agreeing with the shareholder who feels that they should be satisfied with this dividend, because if it went down from 90 cents to 72 cents, if they didn't change the payout rate of 69% to 136.5%, they would have got 40 cents. So that is why we are agreeing. We agree that the DPS is better than last year. And this calculation is a proof that it is better than last year, that because if it is 72 cents, if they had kept the 69%, they would have got only 40 cents. Right, we are now proceeding to 3.2.3. 3.2.3, we are required to comment on the risk and gearing. Remember, there was an option in 3.1 which was talking about risk and gearing, and that risk and gearing was matching with E. How is the company managing loans of borrowed capital? We want to look at that. If we are looking at the risk and gearing, we want to see how is this company managing loans and how is this company benefiting from the borrowed money. So comment on the risk and gearing for both years. Quote 2 financial indicators with figures. So the first financial indicator that we look to quote here is the debt equity ratio. Debt equity ratio, which deals with the risk. The first financial indicator that we need to quote here is the debt equity ratio. If you look at information A and you look at the debt equity ratio, the risk has increased. The debt equity ratio increased from 0.3:1 to 0.4:1. Debt equity ratio increased from 0.3:1 to 0.4:1. It is very important to quote figures. Very important to quote figures, because by quoting the debt equity ratio, you will get a mark for that. And also quoting the trend, that is another 2 marks for figures. So it is very important to ensure that when you are quoting the financial indicator, you also quote figures. So the debt equity ratio has increased from 0.3:1 to 0, which then tells us that the risk has increased, which also tells us that the company took a new loan, because by the debt equity ratio increasing is telling us that we took a new loan. But let us then look at the return. Where we're investing the money, are we getting a better return for this amount? That the money that we borrow, are we investing it correctly? Are we getting a good return? So we then need to quote the return on total capital employed. Return on total capital employed. And there is an accepted abbreviation for this return on total capital employed, which is ROTCE. The return on total capital employed. We want to know the money that we borrow from the bank, are we investing it correctly? Are we getting a good return from that money? If you look at the return on total capital employed, if you look at the return on total capital employed, the return on total capital employed has decreased from 39% to 23.2%. Decreased from 39%. Return on total capital employed decreased from 39%. It decreased from 39% to 23.2%. It decreased from 39% to 23.2%, which is a worrying factor, because our risk has increased from 0.3, which tells us that we took another loan. But yet, where we invest the borrowed money, we are not getting a good return. The return is going down. The return on total capital employed has decreased from 39% to 23%, which then tells us that borrowed money is not used effectively. This is telling us that borrowed money is not used effectively to increase the return. Or to increase profitability of the business. Borrowed money is not used effectively. What is it? The risk has increased. If you look at the debt equity ratio, the risk has increased from 0.3:1 to 0.4:1, which tells us that we have increased the loan. But one would expect that if you increase the loan, even the return from where you are investing that borrowed money should increase. But the return on total capital employed has decreased from 39% to 23.2%, which is then telling us that the borrowed money is not used effectively. Right? We are then proceeding to 3.4, 3.2.4. 3.2.4. 3.2.4. Existing shareholders are dissatisfied that the new shares issued on the 1st of April 2020 were sold to the CEO. You need to underline that these shares were sold to the CEO, Idasha. Give 2 reasons why you consider their feelings to be justified. Quote figures for 6 months. Maybe the first thing that we need to do in this question is to try and establish the price at which these new shares were issued. Because the existing shareholders are not happy. They are dissatisfied that the new shares issued on the 1st of April were sold to the CEO. So these shares were sold to the Chief Executive Officer. So if you look at information B, we are getting the number of shares that were issued there. On the 1st of April 2020, the company issued additional 250,000 shares. The total number of shares is 250,000. And if you go down to information C, if you go to information C, in the extract from the cash flow statement on the 31st of, you can see the money that we receive out of that sale. If you go down the information C, you will see that there is sale of shares. The sale of shares is 375,000. Let's start by doing that calculation. The total amount that we received is 375,000 out of the sale, and the total number of shares that were sold is 250,000 shares. So it will be 375,000 divided by 250. The amount received divided, let us go to our calculation so that we get the exact price. So we have 375,000, you divide it by 250,000. And the answer is R1.50. So these shares were issued at 150 cents. These new shares were sold for 150 cents. And they were sold to the CEO. And the existing shareholders are not happy with this decision. And we want to establish as to why. Let us look at the price at which the new shares, the shares are sold in the market. Let us look at the price, the market price of the shares on the stock exchange. If you look at the market price on the stock exchange, it is 410 cents. Now we can see the reason why the existing shareholders are not happy. Because if these shares had been sold to the stock exchange, had been sold on the market, they would have gone for 410 cents. So we are therefore saying that the company is losing out. These shares could have been sold for 410 cents on the market. Company is losing out. So now we can see the reason as to why the existing shareholders are not happy with this decision, that these new shares were issued to the CEO and then they were issued for 150 cents. If you look at this one, it means that the CEO has now benefited at the expense of the company, because if these shares could have been sold in the stock market, they would have been sold for 410 cents, and which then tells us that the company is losing out. And therefore we are concerned that the CEO is using his position to manipulate So the second point might be that we are content that the CEO is using his position to manipulate the company to his benefit, which is unethical. So that is why we are therefore saying that we concur with the existing shareholders who are not happy with these shares that were sold for 150 cents. So I hope this question is clear to everyone. These shares were sold for 150 cents and they could have been sold for 410 cents. So we are concerned that the CEO is using his position to manipulate the company to his benefit, which is unethical. 3.2.5, which is the last question in question 3. 3.2.5, it says the cash flow statement reflected a positive change of 980,000. Provide 2 points why this should still be a concern to the directors' code figures. The cash flow statement, if you look at the cash flow statement in information C, it is showing that the net change is showing an improvement. That the net change is now improved. Even last year it was 510, and the net change for the current year is 980. So everybody is supposed to be happy that the net change has improved. But it is said in 3.2.5, the cash flow reflected the positive change of narrative. Provide 2 points why this should be a concern to me. But there is a concern. Directors are concerned about this improvement, about this net change of 980,000. And if you look at Tara to information C, their concern is justified, because if you look at the cash flows from operating activities, they have a negative amount of 148,008. Cash flows from operating activities, it's 148,080, and is a negative amount, which then tells us that the operating activities are not benefiting the company, of which this is where we are supposed to be getting a lot of money. So, but the money that we ended up, from the operating activities, we ended up with a negative amount, which is showing us that the company is not doing well. That is why, even though there is this positive change of 980,000, but the shareholders still, the directors are concerned that this is not good. And even if when you look at this, at the financing activities, cash flows from financing activities, and specifically in the change in loan, the loan was increased by 651,500. Loan increased by 651,500. So it means this positive change of 980, we look as if the company is doing well with this positive change of 980, but the actual fact is that we are not doing well. When that is why the directors are concerned, because if the operating activities have got a negative answer of 1, it means we did not get anything from operating activities. And this positive change is mainly financed by the loan that we took out of 651,000. So, which is a risk to the business that we are not getting enough from operating activities, and yet we are now mainly dependent on loans. And these, remember, this loan attracts a lot of interest, which might also affect us a lot in the future. So this brings us to an end of question 3, which was based on the interpretation of financial statements. What is concerning is that most students, they do not answer these questions. of which that is where they can score a lot of marks from this section. They only believe in attempting the questions where there is only calculations, but where you need to interpret the question and give the correct response. And you will find that in most of these questions, the answers are provided in the question paper. So we are encouraging you students to ensure that you do attempt to do this question and you have a clear understanding of all these concepts, these accounting concepts relating to companies. You must have a clear understanding when it comes to dividends, that there is a dividend per share. There is also a dividend payout rate. You should be able to calculate the dividend payout rate. And the formula is clear. It is DPS over EPS times 100. You should also be able to understand that when we talk of liquidity, we are not talking of current ratio only and asset test ratio. There are also other financial indicators which falls under liquidity. We made mention of the stock holding period, the stock turnover rate which goes under there. There is also the debtors collection period. There is also average creditors payment period. So you need to be clear when it comes to the liquidity ratios of the business. And another thing maybe to emphasize on in this question is the issue of risk and gearing. This question is always in the exam, and people, they need to begin to understand now. When we're talking about risk, there is only one financial indicator of assessing risk, that is debt equity ratio. And then if you look at gearing, you are looking at the return on total capital employed. And in most cases, you may be asked to indicate whether the gearing is positive or negative. How do you see that the gearing is positive or the gearing is negative? You look at the interest on loan. If the interest on loan, let me make an example. If I borrow the money from the bank, I take a loan, and then the interest rate on the loan is 11%. But where I'm going to invest the borrowed money, I'm going to be getting a return of 28%. That will be indicating a positive gearing for the business, because if the return that I'm going to be getting is more than interest, so that there is positive gearing. But if you borrow money at an interest rate of 11% and the return that you are getting is only 9%, is even less than the interest. So that is not a good decision to borrow that money, because you are running at a loss, and therefore the gearing will be regarded as a negative gearing. And in most cases, when you are asked a question which is based on the price at which new shares were issued, if you are asked a question which is based on the price at which, whether you are happy with the price at which the shares were sold, or you are unhappy about the price, you need to compare. The first thing that you need to do, you compare the net asset value per share and the market price. If I can make an example by taking this cell phone. If this cell phone is sold, let's say for 3,000 rands in the market, and then I decide, and the value of the cell phone, let's say the value of the cell phone again is 3,000 rand, and it's sold for 3,000 rand, which means if I can apply the ratios, the NAV of this phone is 3,000 rand, and even the market price is 3,000 rand. So if I then decide to sell it for 1,500, and one person will be asking, is this person happy with the price at which the cell phone was sold? The answer will be very clear that no, he will not be happy, because 1,500 is less than the value of the cell phone, and it is even less than the price at which this cell phone is sold on the market, which is the market price. So in most cases, when you are asked a question which relates to the price at which new shares were issued, you need to make sure that you quote the value, you look at the value, which is the NAV, the net asset value per share, and you look at the market price. And then lastly, based on the cash flow statement, what we are getting from 3.2.5 is that you don't have just to look at the amount, and like here, there has been a positive change of 980,000. But you need to go deep as to where this 930,000 came from. Because now if you look at the operating activities, we did not get anything. There is a negative amount of 148. So we can see that the positive contribution towards this 980 was that we took a loan. And we understand that taking a loan will sometimes affect us in the future because it attracts a lot of interest. So that is why we were saying, even though there is a positive change, but the directors are still concerned because the business is not making money from the operating activities and is now becoming to be dependent on the loans. So this brings us to an end of question 3, which is taken from the accounting paper 1 November 2020 in brackets 2. So thank you very much. All right, welcome back. We are now proceeding with question 4. We are still on the same paper, that is November 2020 in bracket 2 exam. We started by doing question 3. I hope you have all captured it correctly. And we are now proceeding with question 4. Then after question 4, we will then decide which question to go back to. But our intention is to ensure that we do this whole paper and finish it. And the reason why I started with these 3 and 4, it's because the observation when we are marking accounting scripts is that most of these learners, they leave this question blank and they tend to rush and do the income statements and the balance sheet where there is a lot of calculation. And where there is theory, they just ignore because they believe that theory is difficult, whereas it is the most easiest, so long as you have the right interpretation and you know the concept and you are clear with what you are doing. The chances of getting it 100% correct, they are very high. So that is why I would invite that you pay undivided attention as we are now doing question 4, which is a new question, because these questions were not there in our previous papers, the 2019s, the 2018s, and the 2017s. So this one is almost a new question, which is corporate governance, question 4. Question 4 was based on corporate governance. Shareholders and employees associated with the company will be particularly interested in whether the company is well governed and managed by the directors. At the AGM, the shareholders will elect 2 types of directors. The first type of director will be the executive directors. The executive directors, they attend board meetings and they work at the company on full-time basis. It is very important that you clearly understand the difference between the 2 directors. There is executive directors and there is also non-executive directors. So the executive directors are those that they attend board meetings and they work at the company on full-time basis. They are permanently employed by the company and they are working on full-time basis. But the non-executive directors, they also attend board meetings, but they do not work at the company. Those are the non-executive directors. So you are provided with 4 aspects of corporate governance that will be of a concern to the stakeholders. 4.1, that's the audit report, which is 4.1, the audit report. The first question in 4.1, it says, explain why a qualified audit report is not a good reflection of a company. Provide 2 points. Remember, after a thorough audit that will be conducted by the independent auditors, the independent auditors then write a report. And the reports that we may expect from the independent auditors, they vary. The first one that all companies are always expecting is an unqualified report. And an unqualified report is an excellent report where everything in the company has been done correctly, where the financial statements are in accordance with the GAAP and they are in the manner that is required by the Companies Act. There is also a qualified audit report, which is not a good report. A qualified audit report is not a good report because this report is indicating that maybe 1 or 2 aspects could not be verified. Maybe there is information that is missing, and therefore the auditors will then issue a qualified audit report. There is also a disclaimer of opinion report, a disclaimer, which is a very bad report. A disclaimer of opinion, when it is issued by the auditors, it is when the financial statements are not in compliance with GAAP, they are not in the manner that is required by the Companies Act, they did not even comply with the International Financial Reporting Standards. So the disclaimer is a very bad report. But our first question under question 4, here it says, explain why a qualified audit is not a good reflection of the company. Provide 2 points. So I think from what I've been explaining, you can be able to provide an answer. When it says it's not a good reflection of the company, it's because this report indicates that there is information. It indicates that some information is unclear, or maybe there is an information that is missing. Some information, it indicates that some information is unclear, it's not clear, and maybe that there is information that is missing, which is not a good reflection of the company. And this may result to a company losing. The company may lose potential investors. If the potential investors see that this company has been given a qualified audit report, so they may not want to invest in that particular company. So this company may lose potential investors. And we are not looking at it in the point whereby it's losing the potential investor. They may even lose the existing shareholders. When the existing shareholders get to realize that they have been issued with an audit report, so therefore they may decide even to leave the company if they have been issued with a qualified audit. So this qualified audit report has got a very negative impact on the company. Even when the company is applying for loans in the bank, they may not be granted loans because of this qualified audit report. They may even be charged when it comes to things like when they are submitting for their tax returns. They may not get, they may not save money from their taxes because it is clear that some of the information here is missing and is not there. And this is also reflecting that there is lack of internal control, which is a very important point. This qualified audit report is showing that there is a lack of internal control. This is another point that you may include, because if there is proper internal control in the business, therefore the company may not get a qualified audit report. So let us then proceed to 4.2. 4.2, explain why it is important for a company to include the non-executive as well as the executive directors on the board of directors. Explain why it is important to include the non-executive as well as the executive directors on the board. So this question, if you just look at it generally, if a company has got only the executive directors, it means the opinions that they will be getting on the management of the company will be coming from one perspective, from a narrow view of the executive directors. But if you also include the non-executive as well, people who are coming from outside with the necessary expertise or with the necessary skills required by the company to improve, they may add more value to the company. So more opinions. So we are saying, the question is asking, why is it important for a company to include the non-executive as well as the executive director? We are saying that if we have the non-executive and the executive, more opinion from different views may be obtained, and thus may result to the company being improved if we are having different views. And remember, the non-executive may also act as watchdogs. This is an accounting concept, watchdogs. Remember, even the external auditors, they serve as watchdogs to the directors. They are there to prepare to protect the rights of the shareholders. Even the non-executive directors may also act as watchdogs to the executive directors. And therefore the executive directors may not do as they please, because they know that there is also another sector of the directors, which is the non-executive directors, who will be there in the meeting, who will make them to account if there is anything that is going wrong with business. So we are therefore saying that it is to the advantage of the company when the company has got the non-executive and also the executive. Remember, the non-executive directors, even though they are not working on permanent basis in the company, but the people who are selected to serve as the non-executive are the people in most cases who are highly qualified and who have got the necessary experience required by the company to guide when decisions are taken. So considering that the executive directors are working on permanent basis in the company, they may be having that narrow view of the company, and therefore bringing on board some people from outside will therefore increase opinions that will be brought into the company, and thus the company will improve. Right. And another thing that we may also consider when it comes to the non-executive are important. And remember, the non-executive may not be as expensive as the executives, because the non-executives are not working on permanent basis in the company. So they only come there to sponsor their expertise and then they leave. So it is a better idea that they are those people who are employed as non-executive, so that they are able to assist the company. And then 4.3, according to the Companies Act, a company must have a remunerations committee, explain the role and give reasons why this committee is necessary. A company must have a remunerations committee. So we needed to have an explanation why, explain the role and give reasons why this committee is necessary. So the role of this committee, which is the remunerations committee, is to decide and approve salaries or bonuses. They have to decide and approve salaries and bonuses of the workers. So their role is to ensure, they are there to ensure the role of the remunerations committee is to decide. They have to sit down, the committee needs to sit down and decide, and they also have the responsibility to approve salaries and bonuses of the workers. Their main role is to ensure that there is fair remuneration of all employees of the company, so that they may not just, the directors may not just decide on how much they give and they do as they please. So there has to be a committee that will sit down and look into all considerations and therefore decide that this is how people are going to be paid and how much are going to be the bonuses for this current year, and make a consensus decision with regards to that. And remember, in a committee, all parties are represented in that remuneration committee. So therefore, a decision cannot be made by only one person, and therefore make a decision which will be benefiting him or herself. So it is therefore important that there is a remuneration committee. And remember, this is according to the Companies Act. So it is something that is in the legislation. If something is according to the Companies Act, it means that if the company does not have the remunerations committee, so it means that the company will be in breach of the Act and may be charged for that. And number reasons for that, number reasons for the explanation, what is their role, it is to decide and approve salaries. Number reasons for that, we don't want a situation whereby directors should not be the only one deciding. This is to prevent fraud which might happen, and to prevent the reasons for this committee. The role of this committee, you need to be very clear with the role of this committee, that this committee is to ensure that they sit down, they look at all the factors, they look at all considerations, they then decide on how much are the workers going to be paid, are we going to have bonuses this year, and make sure that there is a fair remuneration to all employees. And the reasons for that is to make sure that the directors should not be the only one deciding. They should not be the only one deciding on salaries. They should not be the only one deciding on salaries. And this might, if they are the only ones deciding on salaries, we might end up having a situation whereby the directors are paying themselves more at the expense of other workers. And this is also to prevent fraud, and this is to ensure that there is fairness in the distribution of salaries. There is fairness in the distribution of salaries. Right. 4.4. 4.4. Directors engage with clients on a regular basis in an effort to negotiate contracts and to increase sales and services. Directors engage with clients on a regular basis in an effort to negotiate contracts and to increase sales and services. So we are required to explain why there should be a company policy for all gifts, donations or favors received by the directors from clients to be declared to the board by the directors concerned. Provide 2 points. So it means that there is a situation whereby we'll find that some of the service providers will be giving gifts to the directors. They are giving donations to the directors on their personal capacity, and according to the Act, those gifts must be declared. And this question is therefore asking us, why are those gifts have to be declared? Why is it important? It is said, explain why there should be a company policy for all gifts, donations or favors received by the directors from clients to be declared to the board by the directors. Provide 2 points. And the first point, we want transparency. The first point, that is transparency in providing or in awarding tenders. We want transparency in awarding tenders. So what we are saying, the reason behind this act of saying that this donation should be declared is that this donation might also be viewed as bribery. These donations, they might be viewed as bribery if they are not declared. So that is why we are saying it is important for the directors to declare. Because let's say there is a situation whereby a service provider has given a donation to a director on a personal capacity, and suddenly that service provider is awarded a tender from that particular company. One may end up viewing that as bribery. So that is why we are saying it should be those donations and gifts must be disclosed, so that when whatever that is happening in the company, there is transparency. There should be transparency even in awarding tenders. The necessary processes must be followed so that we know that all legal processes have been exhausted before one is awarded a tender. And therefore we are saying that these donations, if they are not declared, they must be viewed as bribery. So the main idea behind that, and you can see that some of these answers, you don't need to like copy it from the book or get information. You just, some of them, they require your general reasoning as to if a person is given a gift by a service provider. It's a clear indication that this gift, maybe this service provider wants something in return. So therefore, it is important that that gift must be disclosed, so that we ensure that when we are awarding a tender, the right processes have been followed, and that they may not be viewed at a later stage as bribery. So this is 4.4. This was only just 4 questions from question 4, which was based on corporate governance. And if we may just quickly recap on what we have discussed, we were looking at the impact of the qualified audit report, that the qualified audit report is not a good reflection of the company. And we had to provide 2 reasons as to why we are saying it's not a good reflection. It is because we know that when an audit report is issued, it means there is something that is not right in the financial statement. Maybe some of the documents could not be verified, some of the expenditure could not be verified, or maybe some of the documents which were required for audit purposes were not produced by the directors, and therefore it indicates that some information is missing or is unclear. So that is why we are saying it's not a good reflection. And we are looking at it from the point that even the existing holders, if the company is getting a qualified report, they will even decide to leave the company. And if we look at 4.2, where we were looking at the importance of the non-executive and the executive directors, we said the executive directors, they are just working there on a permanent basis in the company, and the non-executive are those who are also the members of the board, but they are not working on permanent. They only attend meetings, and in most cases, these people are highly qualified and they possess necessary skill that is required or expertise that is required by the company. So when they are brought into the company, they then bring that necessary expertise, and therefore they are able to guide even the executive directors in taking decisions. We said if there is more opinion from different views which may be obtained, and thus the company will improve. And even the non-executive may also act as watchdogs. They may be, because the executive directors will not do as they please if they know that there are some people who are also watching over them. And then 4.3 was when we were looking at, according to the Companies Act, the role of the Remunerations Committee. The Remunerations Committee is a committee that is required to decide on the salaries. And why is it necessary that we need to have a committee like that? It is because we don't want a situation whereby there is one person deciding. The directors are the only one who are making a decision. And remember, the directors are also the employees of the company. So they may take the decisions which will benefit them and disadvantage other employees. So it is therefore important that we have a remuneration committee in place which will be taking decisions in that regard. And then explain why there should be a company policy whereby gifts given to the directors must be declared. We are saying that if those gifts are given by the service providers, and at a later stage that service provider is awarded a big tender, that might be viewed as bribery. So we are saying whatever gift or donation given to a director must be disclosed or must be declared, and that when the companies are awarding tenders, there should be transparency in awarding tenders and make sure that all processes are being followed. So that was it with question 4, which is coming from the November 2020 in bracket 2 exam, which was written in 2020. And this brings us to the end of question 4.